Artlist.io. Music licensing reimagined. Artlist.io.
All right. What's going on? What's going on, family? Peace, power, and profit to you guys on this, I guess, D-Day, right? D-Day for the markets, that is, right? This ain't Normandy, right? This ain't Normandy, Germany somewhere. This is good old USA, stock market, live battlefield coverage coming to you guys on this, powerful Wednesday, hump day, if you want to call it that. It's about to be hump day, seriously, but with these markets, right? Again, you guys have been, privy to plan for this. It's nothing new. I'm pretty sure you guys are, again, whether you at work, whether you, out, and about, or you in front of your computer, cell phone, tablets, or whatever, watching this market live right now. Of course, we got 2 minutes here before it goes down live and direct, considering, exactly what this market's going to do in relation to that of the Fed's ideal of tapering rate hikes, or just playing the fiddle a little bit more, kicking the can down the road, playing the dovish tone, and somewhat, appeasing markets, right? As we know it to be a scenario that they're very, very good at, right? They're very good at appeasing the stock market. So with that being said, you guys see my screenshot here on the screen. Again, it's one of those days for bulls and bears, right? You're gonna probably need a chopper today, right? You're gonna probably need somebody to airlift you off the battlefield. You got some, you loaded on puts and not calls, you loaded on calls and not puts, you're not hedged right now. You might need a chopper, right? I don't always have a chopper, but when I do, I get the one, right? You might have to get the one real quick here in a couple seconds. So again, we want basically, 1 minute away. So what I'm gonna do here, I'm gonna cut to the CNBC, right? We're gonna listen to CNBC. And let them detail exactly what's going on as far as rates. All right. So I'm gonna be a little patient here, and y'all can bear with me for a minute. All right, let me get this cracking over here, so that way we can hear it.
Has room to make the case for being more patient, more deliberate in the rate hiking cycle, especially as we get to the second half of next year with the uncertainty around inflation as well.
Let's get a quick thought from Bob Pisani, if we might, before we go to Steve Leisman. Bob, give us the context of where the market is, or why it is where it is today.
An accelerated tapering is not going to surprise anybody at this point. The key question the stock market participants want to answer is, how fast are they going to be hiking rates? This is very well studied throughout history. What kills bull markets is when the Fed suddenly and aggressively raises rates, meaning every single meeting for many meetings, and you have a weak economy. The hope here is that the Fed is going to be very slow raising rates, meaning not every meeting. And what's on the side of the bulls is we have a very strong economy. If that happens, we get gradual rate hikes going into 2022 and into 2023, and the economy stays strong, the stock market will be able to handle that very, very well. The wild cards, of course, is how aggressive, and number two, the course of the Omicron variant.
I mean, if you had to game out the reaction of the markets, and we love to do that here on CNBC, don't we, Rick? I mean, it sounds like the markets overall would be flat to higher potentially. I mean, as long as we don't get an extremely hawkish surprise. Actually, you know what? We're going to get straight to. I'm sorry, we're going to get straight to Steve Leisman, because we do have the Federal Reserve's decision on interest rates. Steve.
The Federal Reserve doubled the size of the taper to $30 billion a month. The Federal Reserve adjusted the tape, said that it will adjust the taper further if warranted. It did leave the funds rate unchanged at 0. It said it's prepared to adjust the stance of monetary policy if warranted by the economic outlook. It will maintain 0 rates until maximum employment is achieved. Now, the Fed is no longer using the word transitory, doesn't call inflation transitory. More on that in a second, but I want to show you what it looks for. The median Fed forecast now looks for a 0.9% funds rate in 2022. That's up quite a bit from where it was, and even more aggressive than we saw in our CNBC Fed survey, and for 1.6% for 2023. So call that what you want to call it, 3 or 4 hikes next year. 2 or 3 hikes next year, and another 3 the following year.
Listen to him trying to downplay that 2 or 3 hikes as if that's not big.
That's a rise from its prior forecast.
Wow.
But it does see it coming down in 2022 to 2.6%. The Fed saying supply-demand imbalances are what are contributing to the.
We're talking 2 to 3. We at most we forecasted maybe 2. They're saying 2 to 3.
The decision was unanimous.
And he's trying to downplay that as if that's not big.
The unemployment rate has declined substantially.
Wow.
Now, importantly, and maybe somewhat amusingly, the Fed said it is no longer seeking inflation above 2%. So doubling the taper, but keeping it 0 and saying maintain it until maximum employment is achieved. Kelly?
I'll take it, Steve. It's Melissa. Just taking a look at the market reaction. Initially, knee-jerk reaction off the back of this. We do see the NASDAQ down, still by about 0.7%. We did see it dip a little bit lower on the back of it. The S&P 500 down by just about 0.3%. Not too much so far as we continue to digest and await the statement and the press conference.
And she's trying her best not to say interest rate hikes.
To get to the decision, but what are you seeing in your neck of the woods in terms of reaction?
Curve flattening. This was definitely built in, and the built-in nature of this bringing the rate hikes forward. We can debate whether the market's right or the plots are right. It almost doesn't matter. And that is steep flattening the curve, meaning short rates are outdistancing on the selling, pushing them up to the longer maturities. But here's the key that I see. If you're going to make the Omicron variant an inflationary experience, and I understand what the chairman and committee are saying, then you're making a stagflation argument, because the variants are slowing the global economy. There's very little doubt that the Delta variant slowed the global economy. So it hurts supply chains, even though Milton Friedman might argue as to how much inflation that really generates in and of itself. It does cause prices to go higher, and it causes things to slow. It's a stagflation argument. My last point is that as of last Thursday, which was the 9th, the Fed's balance sheet was $8.714 trillion. Pre-COVID, it was $4.2 trillion, and pre-credit crisis, it was under $1 trillion. We borrow 42 cents of every dollar we spent. That's before the BBB gets passed, if it does get passed. Rate hikes need to occur, but the effect it's going to have obviously seems to be the message that equity traders are trying to deliver, along with the very low interest rates of the long maturities. They all seem to be delivering the same message. Are we going to hurt the economy by raising rates, even though we need to combat inflation? These are questions that we're going to see the market try to answer in the next couple of weeks.
Yeah, by the way, we're also seeing a spike in the 10-year yield. So we're seeing the whole yield curve sort of go higher. So it's not just a flattening that we're seeing on the back of the decision. David Kelly of Jpmorgan Asset Management joins us now. David, what's your initial reaction to all of this?
Well, I think it was entirely appropriate to accelerate this taper. I mean, we have substantially lower unemployment than they thought back in September. We've also got substantially higher inflation. I don't agree that the Omicron variant or the current wave of the pandemic is actually inflationary, because I don't think it's going to affect supply chains that much. I think the supply chain issue will gradually fix itself, but we do have stronger underlying inflation. It's inappropriate for the Federal Reserve to be keeping rates this low, given that we're well above 2% inflation. And of course, they're continuing to foment asset bubbles. And I think this is something that the Fed really needs to think about. You don't want to just push asset prices higher and higher, on the back of zero interest rates. So I think
definitely swung me some positions.
That they're tapering, and I hope that
both sides, long and short,
they do begin to raise the federal funds rate.
But let's go back to check in with Steve Leisman, who has poured over the statement and has some thoughts. Steve, jump on in here and particularly drill down on the interest rate probabilities for 2022 and beyond?
Oh, I'm definitely taking some profit here too.
Yeah,
Hell
I'm not seeing much change, and I am always lucky to be backed up by my colleague from Chicago. It looks like the market had this priced more or less. I see the Fed being a touch more aggressive. Of course, that's just a median forecast of your average Fed official. It's not a policy statement by the Fed, but many more now see rate hikes in 2022 than saw them before. It's a touch more aggressive than the market is, but you see that, by the way, in the 2-year yield, which is up about, 71, 72 basis points now. So a bit of a spike there. Something of an increase in the 10-year yield, but still to the point where, at least the last I checked, the curve had flattened even more. Yeah, quite a bit. You went from a 78 basis point wide to now 75 or 74 wide even. So it did crunch a little bit. I think there's a message here, and I don't want to take too much from it, but the market seems to think, at least the fixed income market, seems to think the Fed has its back on inflation. Maybe that's just crazy to say, but I wonder if members of the panel, Tyler, do you think the Fed, if it needed to, could not get control of inflation? I think the market is sending that signal that that's what the Fed wants to do. It can do it.
Yeah. Let's go to Bob Bazzani now for some stock market reaction. What are you seeing, Bob?
Not much movement. I want to show you the S&P 500 and point out something, and I would agree with Steve here. The market has generally been applauding the Powell pivot. They wanted to move in this direction. In fact, the S&P 500 at 46.48 or so, that's about where it was when Powell began the pivot in November 30th. We have not changed much in the overall indices. However, the composition of the market has definitely changed. Look at today's sectors, again, reflecting much more defensive tone in the market. So we've seen recently consumer staple stocks stronger, healthcare stocks stronger, utilities, for example, have been hitting new highs recently. Those are definitely defensive sectors. At the same time, we've seen a little bit of a rejiggering in tech stocks, which are very sensitive to potential rate hikes, even modest rate hikes down the road. So, for example, software stocks have notably been on the downside in the last 2 or 3 weeks. We've seen other big, more speculative areas of technology. Kathy Wood's ARC Innovation Fund.
I'm low in positions, guys. I'm getting right, taking a little profit, low positions, dumping a couple losers, and getting ready for basically the meeting.
Rate concerns, more defensive names are generally higher, and overall the S&P 500 is the same. But the bottom line here is,
which is obviously,
not that far from where we were
when they
began that
or whenever he speaks, possibly tomorrow, if I'm not mistaken.
Rate's going to go, and you heard Steve talking about 0.9%. Let's call that 2.5 rate hikes for 2022. That's about where the market was. Maybe we're thinking 2.5% was the final terminal amount in 2023. I think, Steve, I heard him mention 2.6%, maybe a tad higher, but the market has been going along with him, and it seems to be pricing in the exact expectations the Fed are talking about today. Guys,
I mean, that is critical, Mona, right? I mean, because if we are to believe that the market has actually priced this in, then that correction that we've seen in higher valuation names, we might say a bottom has been put into these stocks as we see
propaganda. This is why I don't listen to CNBC,
such a steep decline
because again, they're paid by corporations to always make their companies look good, make the market look like it's strong, present the facade that America is solid. Again, we don't play that old ideal of everything is great. Inflation is a sign that it's not great. So make sure you guys understand that.
This is the start of an interesting rotation under the hood.
We'll let them play the TV game, but we know better.
We'll probably get one leg higher in the value cyclical rotation, especially if we do get a reopening 2.0 at some point next year. But we also think those defensive assets, not only are they a little bit more defensive,
we're going to play the position one way or the other, so be cautious of that.
Which is important. So areas like staples, like healthcare, even parts of utilities, in an inflationary or higher elevated inflationary environment, they have pricing power and they have room for catch up. And one final note I'd make, the terminal rate of this Fed, I think, is very important. I think not only when they start raising rates, how far do they take it? And we've seen lower peaks on the Fed's terminal rate in history. So last 2 cycles, 4.25%, 2.25%. It looks like the Fed has baked in for 2024, 2.1%. So much more digestible terminal rate for the broader economy overall. I think that'll be viewed positively as well as the markets start looking towards that direction. So some rotation under the hood, but generally a Fed that probably is a little bit more accommodated for the overall economy.
They
John
try.
Bellows, you run
Boy, they
money.
try
I
so
wanna
hard.
know
They
what-
try.
Now, given the roadmap that the Fed has laid out here on this day
This
in
is
December,
CNBC.
what do you expect you're going to be doing within your portfolios that you run in terms of heavying up in certain sectors, lightening up in others?
I think it's interesting that the market's priced on top of the Fed for 2022. It has about 3 rate hikes. The Fed's now at 3 rate hikes. And so as an investor, you kind of have to say, well, where are we relative to the Fed? And, my guess is that Jerome Powell is going to be pretty careful not to overcommit to those 3 rate hikes next year. The reality is that when they're ready to start thinking about hiking rates in March or certainly by June, we're going to have a much different inflation and growth environment than we do right now. We're going to see some moderation in inflation. The growth numbers are unlikely to be sustained at what we saw previously. You already saw a little bit of that in today's retail sales number, which was disappointing. And so I think Powell's going to not overcommit. And so as an investor, market's priced on top of the Fed. And I think you need to think about that because, it seems to me that if we're in a different environment next year, the chances are they undershoot in terms of rate hikes. Now, undershooting in terms of rate hikes, if that's in the environment of still strong growth, isn't necessarily bad for risk assets and for credit and for other spread sectors and fixed income. But that's the type of exercise. Where is the market? Where is the Fed? And then where are the risks relative to that? And again, if we're right that the environment is much different next year in terms of growth and inflation, I think the risks are probably on the downside in terms of the rate hikes that they deliver.
This exact panel has been in place for Fed decisions many, many times, and we have sat in the same position where we have dissected the statement, then we go into the press conference, and it's a very different story. David, it feels like this press conference, there are a lot of potential landmines, tape bombs, if you will, that Jerome Powell will have to navigate. What do you want to hear more about when it comes to the color around the dots or the characterization of inflation?
Well, first of all, I'd be interested to hear what he has to say about the Omicron variant and how much the Fed's policy still depends upon the course of the pandemic. So he may give himself an out there, which I think the bond market would find was somewhat friendly. The other thing that I think is important is, does he say anything about asset prices? Does he talk, or is this just about inflation and unemployment? Because as John said, a year from now, chances are inflation will actually be coming down a bit, and the economy will be growing more slowly. If it's just about that, then I think the market should be skeptical about whether the Fed actually follows through on this. But if the Fed realizes that there's something long-term inappropriate about keeping negative real interest rates in a otherwise healthy economy, if they say anything like, the chair says anything like that, that I think would be more negative for the bond market. So I really want to hear, is there any other rationale, or is this just about inflation?
Steve Leisman, what say you?
So there was a sentence in the statement that doesn't make sense on first blush, and I may have figured it out, and I want to read it to you. It says that with inflation having exceeded 2% for some time, the committee expects it will be appropriate to maintain this target range until the labor market conditions have reached levels consistent with the committee's assessment of maximum employment. That doesn't make any sense on first blush. You think with inflation being above target for some time, we need to change the rate. Unless you go to the SEP. You go to the SEP, you see, well, the Fed expects unemployment to fall to 3.5%. It has a long-run rate of 4%, which means that if you read this in conjunction with the SEP, the Fed is not far from rate hikes, and maybe just, I don't know where we're at right now, but we're very close to the idea that the Fed sees the employment trigger to begin hiking rates. And I'm not sure when that could be, or even if that's separate from the taper. I think that's one of the questions we're going to ask Fed Chair Powell. What if you get to that maximum employment rate and then you're still tapering? Could you then raise rates?
I think that's a critical point that's being made, because the dual mandate, the maximum employment, it had to be inclusive, it had to be broad. It wasn't just a target number. And so this color, Steve, would seem to me to be sort of a very critical aspect in terms of how the market should interpret this whole thing.
I think that's right. I mean,
Steve, go ahead, and then we'll go to David. Steve first.
No, just real quick. I mean, we're very close to that number, and I think that the question is whether or not we still have that separation where tapering and rate hikes are separate, or is there now a sort of a standalone criteria or trigger for rate hikes that could come if the Fed reaches that maximum employment rate, which looks to be either the 3.5% it's forecasting next year or the 4% long run rate.
Right. I'm sorry. Was it John who wanted in? Before we were deciding whether or not we would divorce the notion of taper and rate hikes, thinking that you can do the taper and then wait for some time for rate hikes. And this is a new notion that you could do taper with rate hikes on top of that, John.
You know, I think the way to understand that sentence that Steve just read is it's replacing the 3-part test for liftoff and now saying the inflation part of the liftoff test has been met. And the only thing that hasn't been met is the maximum employment test. So it's an evolution there. They say we've met on the inflation objective or the part of that test, but we have not met on the maximum employment. I guess another thing that I think we'll be interested to hear is how much Chair Powell leans into the unemployment rate. Unemployment rate has dropped quite a bit. You know, if you're just looking at the unemployment rate, you know, you're getting a message about the labor market. But there are other measures of labor market strength that don't look as compelling, in particular the number of payroll jobs, which is still 7 million below trend. Labor force participation is quite low. The employment population ratio is quite low. And so if he leans into the unemployment rate, you get one message. But if you look at those other measures, you might get another message. So I think Steve's right. The focus will be on maximum employment. That's the only part of the liftoff test remaining. That's what will matter for when the rate hike occurs. And I think in terms of today, how he characterizes the relative importance of those different measures will be a really important part of that.
Rick, let's get
it's one
through
of
the views. And I was going to go to Rick Santelli, if I might, for one final thought here. As you pointed out earlier, the yield curve is flattening a little bit. The short-ended notes have gone up in yield, and so the yield curve is flattening. As you process all of this, what is your takeaway, Rick?
My takeaway is that the markets have it right. I think where many may go wrong is not remembering the end of 2018 very well. You could all debate what the terminal rate's going to be. The market is going to have its say so. That's when the next bout of volatility comes in. You know, we're at 0 now. And here we are debating, maybe 3 next year, maybe the 2 the year after. We're at 0. And as the Fed actually starts to raise rates, the markets are going to have something to say about it. One final thought. Yes, we're stopping 120 billion with regard to the taper, removing some of the buying. We certainly aren't removing any stimulation. We're not removing any liquidity. And I think all of those issues we seem to just gloss over as we talk about probabilities of the future.
All right, Rick Santelli, and thanks to our panel as we take a break here. Mona, David, John, Rick, Bob, Steve, everybody, we thank you very much. And Melissa, back to you.
All right, coming up, our Fed coverage continues. Former Fed Governor Frederick Mishkin tells us whether the central bank is on the right track or making a mistake. And Fed Chair Jerome Powell will take the podium in just a few minutes. Live coverage of his press conference as soon as it starts. Keep it right here on CNBC.
All right. So in that commercial break, I guess I can come on and do a little commentary. So again, I'm pretty sure you guys been seeing it all across your cell phones who are obviously, subscribe to a lot of these different newsreel publications when they come out, considering interest rates and just market news as a whole, right? So interesting enough, of course, y'all heard them speaking about it live, of course, in terms of that. These are things that we kind of already talked about leading into today, that we know that we will get a taper at least double that of the current status at 15 billion. It would be 30 billion, right? That's nothing new there. So here's what's interesting. Again, they lumped it all in one kind of course conversation on one of the news publications where it says the Fed will be buying $60 billion of bonds each month starting in January. So basically 60 billion, coming from where it was at 120 billion. That's the deduction that we've already gotten from, doubling up and potentially this month, which is 30 billion from the 15 billion from last month, which is obviously that of what, 45 billion, right? Leaving what is that? Is my math correct? Right? 45 from 120, right? By 85 billion, somewhere around there, 80 some billion, whatever. So they're saying now the Feds will be buying 60 billion of bonds each month starting in January, half the level prior to November taper, and 30 billion less than it was buying in December, right? So yeah, you got a few left within that they're going to push. So I guess at this rate, they're looking to be done with the tapering, ideal of that, meaning resending that money around about March, somewhere around there, March, April or March, if my math is correct, right? Y'all can double check me on that. So half the level again prior to that November taper, 30 billion less than it was buying in December. The Fed was tapering by 15 billion in a month in November, double that in December, then would accelerate the reduction further come 2022. After the taper wraps up, right, in late winter, early spring, the central bank expects to start raising interest rates, right, which were held steady at this week's meeting, right? We know that we were kind of still around that quarter basis point near zero, right? For the longest since COVID, obviously, right? And before that, even with tariffs, no surprise there.
Welcome back to the special
all right, so 1
edition
second.
of Power Lunch. I'm Melissa Leal.
All right, so let me just finish it, and we'll get back to listening to them, pander to, Wall Street. Right. So projections released Wednesday indicate the Fed officials see as many as three rate hikes coming in 22. Again, we forecast, maybe two. I was talking maybe two. Now I knew we were probably gonna get one, and that's just because they could not escape the CPI and the PPI data that was starting to show that inflation was starting to really, really ramp. So that's what inflation does. Once it gets going, it's like a boulder downhill with with grease underneath it. It's gonna continuously ramp and go harder the more you don't do anything to try to abate it, right? To slow it down, to stop it. And we know that they were doing everything they could within their power to downplay the ideal of doing something aggressive to stop the inflation. Why? Because they feel like Americans can suffer the blow a little bit longer and deal with the idea that inflation, in some ways can be transitory in their mind, to think that, okay, they can weather at least 2 to 3 months, right? That's how they kept playing this. They were doing it by quarters. That's how they do. They play by the fiscal calendar, right? Because, that whole transitory conversation was starting last year into the, Q3, Q4 cycle when Jerome Powell kept speaking all this transitory. We knew better. But anyway, so they're planning the quarter, timeline value to seeing if this thing can correct itself. But obviously it got worse, right? Used cars are up over 30-some%. Houses, rental prices are up 20 plus 15, 30% in some cases, but some places around 20%. I mean, on and on and on. We can go on and just throw out that data. We've been there. Now, granted, they're saying 3 rate hikes. Now, that's more than what Wall Street was thinking about. See, don't let Wall Street lie to you on that one. Wall Street was expecting at least, they're going to say 2 just for today because they found out earlier this week or last week, going into this week, that the Feds are now thinking about 2. They were thinking 1. Right? Let me let that, marinate for a moment. Wall Street was planning for 1 particular rate hike, for next year. And they were thinking around maybe Q2, around about Q3, timeline of 2022, right? Basically in the fall of next year, right? Again, that's that whole, it's going to be okay because they got to pander to their clients to say, hey, this is the timeline. This is what we're doing with your portfolio. We're going to stay risk on. We're going to stay heavy in growth stocks. We're going to blah, 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 blah. We don't think there's any kind of need to be alarmed, for you to pull funds and go to cash right away. And keep in mind, we at record levels of margin right now in this country, right? This is the first time ever in American history where we've been this levered up in that of margin, meaning people are borrowing money to invest in the stock market. Why? Because they feel like there's no other alternative, right? Everybody ran to the markets. That's typically what happens in these scenarios when, again, the economy is still sputtering. We have a pandemic like we're dealing with. We got inconclusive data coming with these viruses. Why? Because they politicized the whole ideal of the pandemic. So people don't trust government, which they shouldn't anyway, because the government is not there to obviously play the role of you making logical decisions over your life. You have to make those decisions for yourself, period, first and foremost. And then you resort back to government when there's a necessary need, when they're trying to, pay it forward by giving you your tax dollars back in some kind of form of policy or whatever. Outside of that, you have to be the king or the queen of your own castle. Do your own research and not play the game of being airheaded. That's not how life works, right? You have to be autodidact mindset out the gate. Moving on from that, getting back to the numbers. So again, they are expecting as many as 3 rate hikes next year, with 2 of them following in the following year and 2 more in 2024. Did y'all hear that? So 3 particular next year, 2 in 2023, in particular 2 more in 2024. So if we do that by quarter basis points alone, right? So how many is that? Right? That's 6, right? That's 6, right? That's a 0.6 increase value. And you do that by 0.25. So that'll give you the number that we're talking about. And we just using 0.25 as the standard. Why? Because we know they cut at a 0.25 basis point perspective, given the rate cuts that we got back in 2018, going into 2019 because of tariffs and because of COVID. So that's basically 6 times 0.25. Somebody do that math for me real quick and throw that in the back chat, right? Throw that in your respective chats, wherever you're at, on Facebook, Twitter, whatever, right? So that's the particular ideal of where they're projecting rate cuts to be, or excuse me, rate hikes to be by that of 2024, right? And that's just a preliminary understanding. That can aggressively change. Why? Because of inflation, right? They're not going to, inflation not going to automatically just roll up and roll out because now we got this data that they're going to cut rates to help it. No, those costs are still going to be there. Lumber is still going to be up. Cotton is still going to be up. Soy, wheat, sugar, all that stuff is still up. Why? Because again, they didn't get ahead of this stuff earlier. They placated and pandered to the idea that it was transitory. We knew that was a lie from the gate. We knew that was a very incendiary and very reckless terminology that they could have used at that point. And they played on the backs that Americans would sit there and trust in them that they were going to be taken care of, right? Which we know that was a whole lot of hogwash. Why? Because they threw y'all guys 2 little stimmy checks and said y'all should be good. Again, you couldn't make this stuff up, right? And because of that, they took the ideal of the Americans, people, trust in the Federal Reserve that, okay, well, you will make sure that you're going to do everything in your power because you keep saying maximum employment, help with the wealth gap, do things to kind of better protect the American citizen. Well, in essence, all he did was protect the who? Asset owners, which typically that's what the Fed does. It's a lie to believe that they're there to what? To protect Main Street. That's what they're supposed to do, but we know that's been debunked years ago, right? We know that the Federal Reserve at this point is highly infiltrated with what? Wall Street bankers, hedge funds, people who are always in the ear constantly. Why? Because basically since the 70s, we've been getting a slew of what? Hedge funds and banking executives, whomever, who moved into the financial space to take over these high chair seats in government. A conflict of interest. They're already coming in with the idea that we want what? Low taxes and cheap money. Why? Because they can grow their gains exponentially. Not, rocket science, guys. Not rocket science. Understanding how government works is a part of our daily, in my opinion, our daily bread of understanding how finances work. Right? Again, America only panders to those who own assets, period. In the discussion, if you think you could just get a couple of benefits here and there, you think you're doing it. No, they owe you a lot more. And the only way you're going to be able to receive that if you learn how to put your money to work for you methodically, right? Because that's what, American, the corporation obviously is made up of, right? It's asset ownership, right? So that's the part of it that makes this stuff gets crazy. So just keep that in mind, guys. So just putting that out there real quick. You guys can see this, I guess the excerpts of this stuff all over the place through news publications. So make sure you follow those. So again, Jerome Powell will be speaking shortly. I am going to make sure I have that on audio so we can listen in, right? So you can kind of hear him, go through his popping and pinging and dry mouth, and then and having to deal with the reality that he just got his behind drug about a week or so ago from the congressional hearings, him and Janet Yellen, where they could not run away from dealing with the reality of the questions that were pressing a lot of Americans right now, right? Why is inflation this high? Why is it that, the stock market is roaring and yet we can't really get any kind of financial, backing to help our situations, right? Right. We keep hearing government say this and government says that. Then you guys will say, well, that's Congress's, the job to better, implement policy to help you guys. And then Congress said, that's the Fed's job. So they point the finger back and forth, but they're the same body in a sense. See how that works? And in between, the American person or the citizen is confused, not knowing like, well, what's this about? But anyway, so that's that. So the Jerome Powell will be speaking in the next minute. So let me get through another portion of this real quick. So again, we're talking about 6 rate hikes between now and 2024. Make sure y'all put that on calendar, whatever. 6 rate hikes, at least a quarter basis point, right? So the Federal Open Market Committee moves approved unanimously represents a substantial adjustment to policy that has been with the loosest in its 108-year history. This is the loosest they've been in a monetary policy in 108 years. So basically, in essence, what that means that Jerome Powell supersedes any other federal chairperson in terms of monetary stimulus than that even Bernanke, which was a really big dovish, money printing, war, whatever, right? Warmonger when it comes to finance, and even that Alan Greenspan, right? So anyway, so Jerome Powell's about to speak, and I'll come back and we'll finish up from there.
Goals that Congress has given us: maximum employment and price stability. Today, in support of these goals, the Federal Open Market Committee kept interest rates near zero and updated its assessment of the progress that the economy has made toward the criteria specified in the committee's forward guidance for interest rates. In addition, in light of the strengthening labor market and elevated inflation pressures, we decided to speed up the reductions in our asset purchases. As I will explain, economic developments and changes in the outlook warrant this evolution of monetary policy, which will continue to provide appropriate support for the economy. Economic activity is on track to expand at a robust pace this year, reflecting progress on vaccinations and the reopening of the economy. Aggregate demand remains very strong, buoyed by fiscal and monetary policy support and the healthy financial positions of households and businesses. The rise in COVID cases in recent weeks, along with the emergence of the Omicron variant, pose risks to the outlook. Notwithstanding the effects of the virus and supply constraints, FOMC participants continue to foresee rapid growth. As shown in our summary of economic projections, the median projection for real GDP growth stands at 5.5% this year and 4% next year. Amid improving labor market conditions and very strong demand for workers, the economy has been making rapid progress toward maximum employment. Job gains have been solid in recent months, averaging 378,000 per month over the last 3 months. The unemployment rate has declined substantially, falling 0.6 percentage points since our last meeting and reaching 4.2% in November. The recent improvements in labor market conditions have narrowed the differences in employment across groups, especially for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor force participation showed a welcome rise in November, but remains subdued, in part reflecting the aging of the population and retirements. In addition, some who otherwise would be seeking work report that they are out of the labor force because of factors related to the pandemic, including caregiving needs and ongoing concerns about the virus. At the same time, employers are having difficulties filling job openings, and wages are rising at their fastest pace in many years. How long the labor shortages will persist is unclear, particularly if additional waves of the virus occur. Looking ahead, FOMC participants project the labor market to continue to improve, with the median projection for the unemployment rate declining to 3.5% by the end of the year. Compared with the projections made in September, participants have revised their unemployment rate projections noticeably lower for this year and next. Supply and demand imbalances related to the pandemic and the reopening of the economy have continued to contribute to elevated levels of inflation. In particular, bottlenecks and supply constraints are limiting how quickly production can respond to higher demand in the near term. These problems have been larger and longer lasting than anticipated, exacerbated by waves of the virus. As a result, overall inflation is running well above our 2% longer run goal and will likely continue to do so well into next year. While the drivers of higher inflation have been predominantly connected to the dislocations caused by the pandemic, price increases have now spread to a broader range of goods and services. Wages have also risen briskly, but thus far, wage growth has not been a major contributor to the elevated levels of inflation. We are attentive to the risks that persistent real wage growth in excess of productivity could put to upward pressure on inflation. Like most forecasters, we continue to expect inflation to decline to levels closer to our 2% longer run goal by the end of next year. The median inflation projection of FOMC participants falls from 5.3% this year to 2.6% next year. this trajectory is notably higher than projected in September. We understand that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are committed to our price stability goal. We will use our tools both to support the economy and a strong labor market and to prevent higher inflation from becoming entrenched. We will be watching carefully to see whether the economy is evolving in line with expectations. The Fed's monetary policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee reaffirmed the 0 to 1/4% target range for the federal funds rate. We also updated our assessment of the progress the economy has made toward the criteria specified in our forward guidance for the federal funds rate. With inflation having exceeded 2% for some time, the committee expects it will be appropriate to maintain this target range until labor market conditions have reached levels consistent with the committee's assessment of maximum employment. All FOMC participants forecast that this remaining test will be met next year. The median projection for the appropriate level of the federal funds rate is 0.9% at the end of 2022, about a half percentage point higher than projected in September. Participants expect a gradual pace of policy firming, with the level of the federal funds rate generally near estimates of its longer run level by the end of 2024. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. At today's meeting, the committee also decided to double the pace of reductions in its asset purchases. Beginning in mid-January, we will reduce the monthly pace of our net asset purchases by $20 billion for Treasury securities and $10 billion for agency mortgage-backed securities. If the economy evolves broadly as expected, similar reductions in the pace of net asset purchases will likely be appropriate each month, implying that increases in our securities holdings would cease by mid-March, a few months sooner than we anticipated in early November. We are phasing out our purchases more rapidly because with elevated inflation pressures and a rapidly strengthening labor market, the economy no longer needs increasing amounts of policy support. In addition, a quicker conclusion of our asset purchases will better position policy to address the full range of plausible economic outcomes. We remain prepared to adjust the pace of purchases if warranted by changes in the economic outlook. And even after our balance sheet stops expanding, our holdings of securities will continue to foster accommodative financial conditions. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to complete the recovery in employment and achieve our price stability goal. Thank you. I look forward to your questions.
He kept it short and sweet for a reason.
We'll go to Rachel.
He's trying to stay dovish and hawkish in the
Thank you very
same
much,
breath.
Michelle, and thank you, Chair Powell, for taking our questions. The latest FOMC materials say that the FOMC thinks it will be appropriate to keep rates near zero until labor market conditions reach levels consistent with maximum employment. And there are also 3 rate hikes penciled in the projections for next year. In order to set up those hikes, what will maximum employment have to look like? When will you know that that threshold has been met? And how will that be communicated? Thank you.
Here comes the lie.
So maximum employment, if you look at our statement of longer run goals and monetary policy strategy, maximum employment is something that we look at a broad range of indicators.
See, can never answer it correctly.
Include, of course, things like the unemployment rate, the labor force participation rate, job openings, wages, flows in and out of the labor force and various parts of the labor force. We'd also tend to look broadly and inclusively at different demographic groups and not just at the headline and aggregate numbers. So that's a judgment for the committee to make. The committee will make a judgment that we've achieved labor market conditions consistent with maximum employment. When it makes that, it is admittedly a judgment call because it's a range of factors.
Outright lying. There's no number.
Number that sort of dominates.
See,
it's a broad range of things. So as I mentioned in my opening
he's stuttering.
Remarks,
he's lying.
We are making rapid progress toward maximum employment.
This is America,
you see
guys.
that in, of course, in some of the factors that I mentioned.
Unbelievable. outright lying. He couldn't even answer the question.
Great, thank you. Steve.
This is America stealing your tax dollars. This is why you
Thank
got to
Mr.
get
Chairman.
invested.
My question is,
Or start a business and do
it's
something
often said that
entrepreneur-wise.
monetary policy has long and variable lags.
Outright
How
lying.
does continuing to buy assets now, even though it's at a slower pace, address the current inflation problem? Won't the impact of today's changes not really have any impact for 6 months or a year down the road on the current inflation problem? And aren't you actually lengthening that time by continuing to buy assets such that it could be not until the long and variable lag after you end purchases sometime in March that you'll start to have any impact on the inflation problem?
So on the first part of your question, which is why not stop purchasing now, I would just say this. We've learned that in dealing with balance sheet issues, we've learned that it's best to take a careful sort of methodical approach to make adjustments. Markets can be sensitive to it. And we thought that this was a doubling of the speed. We're basically 2 meetings away now from finishing the taper, and we thought that was the appropriate way to go. So we announced it, and that's what will happen. The question of long and variable lags is an interesting one. That's Milton Friedman's famous statement, and I do think that in this world where everything is, where the global financial markets are connected together, financial conditions can change very quickly. And my own sense is that they get into financial conditions affect the economy fairly rapidly, longer than the traditional thought of a year or 18 months, shorter than that rather. But in addition, when we communicate about what we're going to do, the markets move immediately to that. So financial conditions are changing to reflect, the forecast that we made, and basically, which was I think fairly in line with what markets were expecting. But financial conditions don't wait to change until things actually happen. They change on the expectation of things happening. So I don't think it's a question of having to wait.
Can I just follow up, thinking about having to wait? Is it still the policy or the position of the committee that you will not raise rates until the taper is complete? Thank you.
Yes, the sense of that, of course, being that buying assets is adding accommodation and raising rates is removing accommodation. Since we're 2 meetings away from completing the taper, assuming things go as expected, I think if we wanted to lift off before then you would stop the taper potentially sooner. But it's not something I expect to happen. But I do not think it would be appropriate, and we don't find ourselves in a situation where we might have to raise rates while we're still purchasing assets.
Okay, let's go to Colby at the FT.
Thank you, Michelle. Chair Powell, I'm curious exactly how much distance you think there should be between the end of the taper and the first interest rate increase. Back in 2014, the guidance that was given was for the Fed funds rate to remain at the target level for a considerable time after the end of the asset purchase program. Is that an approach you support now, or does the current economic situation warrant something a bit different? Thank you.
So we haven't made any decision of that nature, and so no, I wouldn't say that's our position at all. We really haven't taken a position on that. I will say that we did talk today. We had our first discussion about the balance sheet, for example, and we went through the way the sequence of events regarding the runoff and that sort of thing with the balance sheet last time. And I think people thought that was an interesting discussion. They thought that it was informative, but people pointed out that this is a significantly different economic situation that we have at the current time, and that the differences that we see now would tend to influence how we think about the balance sheet. And the same thing would be true about raising rates. I don't foresee that there would be that kind of very extended wait at this time. The economy is so much stronger. I was here at the Fed when we lifted off the last time, and the economy is so much stronger now, so much closer to full employment. Inflation is running well above target, and growth is well above potential. There wouldn't be the need for that kind of long delay. Having said that, we'll make this decision in coming meetings, and it's not a decision that the committee has really focused on yet.
Let's go to Nick at the Wall Street Journal.
Thank you. Nick Timoros at the Wall Street Journal. Chair Powell, in March, you answered a question about maximum employment like this. You said 4% would be a nice unemployment rate to get to, but it'll take more than that to get to maximum employment. More recently, you have hinted at a possible distinction between the level of maximum employment that's achievable in the short run versus in the long run. Has your view of the level of maximum employment changed this year? And if so, how? And how close is the economy right now to your judgment of the short run level of maximum employment? Thank you.
Right. So the thing is, we're not going back to the same economy we had in February of 2020. And I think early on, the sense was that's where we were headed. The post-pandemic labor market and the economy in general will be different. And the maximum level of employment that's consistent with price stability evolves over time within a business cycle and over a longer period, in part reflecting evolution of the factors that affect labor supply, including those related to the pandemic. So I would say, look, we're at 4.2% now, and the unemployment rate has been dropping very quickly. So we're already in the vicinity of 4%. The way in which the important metric that has been disappointing really has been labor force participation, of course, where we had widely thought, I had certainly thought that last fall, as unemployment insurance ran off, as vaccinations increased, as schools reopened, that we would see a significant surge, if you will, or at least a surge in labor force participation. So we've begun to see some improvement. We certainly welcome the 0.2 improvement that we got in the November report, but I do think that it feels likely now that the return to higher participation is going to take longer. And in fact, that's been the pattern in past cycles, that labor force participation has tended to recover in the wake of a strong recovery in unemployment, which is what we're getting right now. So it could well have been that this cycle was different because of the short nature of it and a very strong, the number of job openings, for example. You would have thought that would have pulled people back in, but really it's the pandemic, it's a range of factors. But the reality is we don't have a strong labor force participation recovery yet, and we may not have it for some time. At the same time, we have to make policy now, and inflation is well above target. So this is something we need to take into account.
If I could follow up, you've talked recently about risk management, and so does that mean that the committee might feel compelled to raise interest rates before you're convinced that you've achieved the employment test in your forward guidance?
So this is not at all a decision that the committee has made, but you're really asking a question about how our framework works. And yes, there's a provision, what used to be called the balanced approach provision, that says in effect that in situations in which the pursuit of the maximum employment goal and the price stability goal are not complementary, we have to take account of the distance from the goal and the speed at which we're approaching it. And so that is in effect an off-ramp which could, in concept, be taken, and it's in our framework. It's been in our framework a long time. I've talked about it on a number of occasions. It is a provision that would enable us to, in this case, because of high inflation, move before achieving maximum employment. Now, as I said, we're making rapid progress toward maximum employment in my thinking, in my opinion, and I don't at all know that we'll have to invoke that paragraph. But just as a factual matter, that is part of our framework and has been really for a very long time.
Thank you.
Thanks. We'll go to Howard at Reuters.
Thanks, as usual. So I guess I got to ask about the elephant in the room, which is the Omicron variant. This seems to already be pushing one of your colleagues, the Bank of England, off its course. Things have evolved very fast there. Hasn't quite hit the shores of the U.S. in full force yet, but people seem to expect it to. So I'm wondering, in your feelings about this, are you convinced that this is going to be perhaps a more infectious but less serious variant of the virus, or are you simply confident that the U.S. economy can continue its divorce from the pandemic?
Well, I think there's a lot of uncertainty, which is why we called it out in our statement, our post-meeting statement, as a risk. We follow the same experts, and we talk privately to the same experts that everyone else does, and read the same articles in the paper and the same research. And so you mentioned the early assessment is highly transmissible, perhaps not as severe, some continuing protection from existing vaccines and also existing immunity from having had the disease. That's a first draft. We're a long way from knowing what it will turn out to be. It may well come to the United States and replace Delta as the dominant variant fairly quickly. That could easily happen. I think there's another step there, though, which is what's going to be the effect on the economy, and that will depend, on how much it suppresses demand as opposed to suppressing supply. It is not clear how big the effects would be on either inflation or growth or hiring. On top of what's already going on, which is quite a strong, wave of Delta that's hitting large parts of the country across the northern United States and all the way to the eastern seaboard, and now coming down. We're having quite a wave of Delta. So coming in on top of that, again, it's very difficult to say what the economic effects would be. I do think wave upon wave, people are learning to live with this. More and more people are getting vaccinated. So people who get the new variant, it affects them much less than it tends to affect in the aggregate people who are not vaccinated. So the more people get vaccinated, the less the economic effect. It won't have an economic effect. Delta had an effect of slowing down hiring, and it actually it had an effect on global supply chains, and that sort of that hurt the process of the global supply chains getting worked out. So it can have an economic effect. I just think at this point we don't know much. We'll know a whole lot more in 3 weeks, and we'll know more than that in 6 weeks.
But if I could follow up, you're clearly from a risk standpoint comfortable putting away one of your tools pretty soon, which sort of implies that whatever Omicron brings, you're comfortable the economy can handle it without quantitative easing.
Yes. I think if you look at the state of the economy and the strength of demand, the strength of just overall demand, the strength of demand for labor, look at inflation, look at wages. I think moving forward the end of our taper by a few months is really an appropriate thing to do, and I think really Omicron doesn't really have much to do with that.
Thank you.
Let's go to Gina at the New York Times.
Hey, Jerome. Thanks for taking our questions. I wonder if you could talk a little bit about what prompted your recent pivot toward greater wariness around inflation.
Sure. So I guess I would go back and, it's been a continual process, really. Inflation really popped up right in the late spring last year. And we had a view, it was very, very widely held in the forecasting community, that this would be temporary. It was quite narrow. A limited number of factors were causing it. And there was a decent amount of evidence to support that view that it would be temporary or transitory, as we said. Certainly, we had 5 months of declining month-on-month, monthly readings of inflation, but we didn't see much in the way of progress on labor supply or on other supply side issues. Then in September, I'd say after Labor Day, it started to become clear that this was both larger in its effect on inflation and more persistent. And of course, I said so on many occasions. And one of the consequences of that is that we moved the taper forward. And it's a much faster taper than had been planned. So we've been adapting. I've been saying we're adapting our policy. So come to your real question. We got the ECI reading on the eve of the November meeting. It was the Friday before the November meeting, and it was very high, 5.7% reading for the employment compensation index for the third quarter, not annualized, for the third quarter, just before the meeting. And I thought for a second there whether we should increase our taper. Decided to go ahead with what we had socialized. Then right after that, we got the next Friday after the meeting, 2 days after the meeting, we got a very strong employment report and revisions to prior readings and no increase in labor supply. And the Friday after that, we got the CPI, which was a very high reading. And I honestly, at that point, really decided that I thought we needed to look at speeding up the taper, and we went to work on that. So that's really what happened. It was essentially higher inflation and faster, turns out much faster progress in the labor market. Really what's happening is the unemployment rate is seems to be catching up with a lot of the other readings of a tight labor market, 0.6 over one cycle. So that's really what happened. And, widely supported in the committee today, as you can see, unanimous vote, but beyond that, I think widely supported this move.
If I could just follow up quickly, you noted that the ECI was one of the things that made you nervous, but you also said earlier that you don't see signs that wages are actually factoring into inflation yet. And I guess I wonder how you think about sort of the wage picture as you're making these assessments.
Right. So what I said, you quoted me correctly. It's so far we don't see wages are not a big part of the high inflation story that we're seeing. As you look forward, let's assume that the goods economy does sort itself out and supply chains get working again, and maybe there's a rebalancing back to services and all that kind of thing. But what that leaves behind is the other things that can lead to persistent inflation. In particular, we don't see this yet, but if you had something where real wages were persistently above productivity growth, that puts upward pressure on firms, and they raise prices. It would take something that was persistent and material for that to happen, and we don't see that yet. But with the kind of hot labor market readings, wages we're seeing, it's something that we're watching. And the other thing, of course, is rents, which are very important. Owner's equivalent rent and rent. That's another thing which is very economically sensitive. Unlike the things that are causing the inflation now, this is economically sensitive, and so would be expected to move up. And so as some things go down, the question is, where will we be when we come out the other side of this? And we need to keep our eyes on those things.
Thanks. We'll go to Chris at the AP.
Thank you. Well, next year you could see growth slowing, and you could see some disinflation, particularly if the Omicron variant does spread more widely. Would you delay rate hikes in that situation, and how would you think about that? And also, how would you explain rate hikes if you do follow through in that kind of situation with inflation fading and growth slowing? How would you explain rate hikes to the public, particularly those who may still be looking for work?
Well, as you know, the SEP is not a plan. It's not something we debate, negotiate over, or really discuss in terms of what the right answer should be. People write down their assumptions, their assessment of appropriate policy based on their economic forecast. And so the median, what you're talking about, the 3 rate increases, that's the median of the committee. The median of the committee is also that growth will be 4%, and that unemployment will be 3.5% by the end of the year. So that's a really strong economy. And of course, if the economy turns out to be quite different from that, then so will the rate. No one will say, oh, we can't change our policy because we wrote something down in December. That no one's ever said that or will. It will. The actual rate decisions we make will depend on our evolving assessment of the forecast. So, for example, if the economy were to slow down significantly, then you would expect that would have an effect of slowing down rate increases. But we'd have to, we look at our 2 goals, maximum employment and price stability, and we make policy based on them, and not with respect to what we wrote down in a prior SEP.
Thank you. Let's go to Victoria Guida at Politico.
Hi, Chair Powell. I wanted to follow up on maximum employment. So, the new framework was basically designed, as I understand it, so that there was a de-emphasis on guessing where inflation would pick up because of employment. And basically, you were going to wait until you saw the whites of the eyes of inflation, and that's how you would kind of know that you reached maximum employment. So I'm wondering, you've talked a lot about the different ways that you might measure maximum employment, but from what I understand, that's still basically the way that you know that you're there is inflation. So is that understanding correct? And how are those signals likely to be clear right now, given that you have inflation that's caused by, these supply chain disruptions that might also lead to, inflation in wages and those sorts of things? So how do you sort of like tease out the signal of maximum employment?
Okay, so let me start by saying that the inflation that we got was not at all the inflation we were looking for or talking about in the framework. It really was a completely different thing. It was to do with, strong monetary policy and fiscal stimulus into an economy that was recovering rapidly and in which there were these supply side barriers, which effectively led to, in certain parts of the economy, of what you might call a vertical supply curve. So, automobile purchases are very interest rate sensitive, and you would think demand would drive up the quantity of cars, but it can't because they don't have semiconductors. So that was a very different kind of inflation. This is not the inflation we were looking for under our framework at all. It's nothing to do with our framework, and the way we've approached it is really nothing to do with our framework. But come to maximum employment, which is really your question. How do you know? So I think you look at prices and quantities. If you want to look at maximum employment, you look at prices and quantities, and the main price you look at is wages. It's one of the things you look at, and it's. So I mentioned a number of the things. You could get to 20 if you wanted to easily, but labor force participation, the unemployment rate, different age groups of prime age labor force participation in particular gets a lot of focus. The JOLTS data get a lot of focus, and wages. That's really one of the great signals. The quits rate is another one. The quits rate is really one of the very best indicators, according to a lot of labor economists, because people quit because they feel like they can get a better job, and there's record amounts, historically high levels of that going on, suggesting again that you've we got a very tight labor market. So on wages, that's the price indicator we look at to tell us, along with all the other data, whether we have labor market conditions that are consistent with maximum employment. And so that's how we think about it. But the one of the complications is that, again, we've got to make policy in real time. So how do we think about that? If we think we can make labor, participation might move up. If let's say we knew that it would start to move up in 2 years, would we wait 2 years or when inflation is running way above target? Probably not. So you have to make an assessment that what is the level of maximum employment that is consistent with price stability in real time is one way to think about it.
Just to kind of follow up on that for a second, if you do raise interest rates next year and you're not certain whether you're at maximum employment, I mean, are you all going to point, when you raise interest rates, are you going to point to ways in which the labor market could still improve?
Yes, I mean, I absolutely. I think whether or not we say we're at labor market conditions consistent with maximum employment next year, we would all be open and I think expect over time that the level of maximum employment that's consistent with price stability would increase further over time. For example, through increasing participation. So we would certainly, we would not in any way want to foreclose the idea that the labor market can get even better. But again, with inflation as high as it is, we have to make policy in real time. We've got to make that assessment in real time.
Thank you. We'll go to Olivia from Bloomberg.
Thank you. Good afternoon, Chair Powell, and thank you for taking our questions. I wanted to follow up on some of your earlier comments about labor force participation. And I wondered, what do you think needs to change in the economy to kind of get a meaningful recovery in labor force participation? And also whether running the economy hot, like in the last expansion, is one way of doing that.
Well, the labor market is, by so many measures, hotter than it ever ran in the last expansion. If you think about it, the ratio of job openings, for example, to vacancies is at all-time highs. Quits, the wages, all those things are even hotter. But what would it take for labor force participation to move up more? That's really, why is it low is the question. So there are a bunch of answers, and all of them probably have some validity. Part of it will be that people, for certain people, they don't want to go back in the labor force because either they're medically vulnerable or they're not comfortable going back while COVID is still everywhere. That's one thing. The lack of availability of childcare made for caretakers is certainly part of it, not just for children, but for older people. It has been pointed out by many that the stock market is high, people's portfolios are stronger. They may go back to being a one income rather than a two income family. The same thing with people's houses. People buy they have a mortgage and with leverage, and the house price increases, the equity they have in their home might have doubled, and they might reach the same conclusion. So and people have savings on their balance sheet because of forced savings, because they couldn't spend on travel and things like that, and also because of government transfers. So for all of those reasons, and it's hard to know exactly the part each of them plays, we have a situation where we've had a shock to labor force participation that is not unwinding as quickly as many has expected. And people, in effect, a good part of it is voluntary. People, and this is how they want to maximize their welfare, and that's certainly their choice. In other cases, it's something that will abate very quickly if and when the pandemic gets under control. And the longer the pandemic goes on, maybe the less likely that people will come back because they get used to their new life and they lose contact with their old jobs. That's what the evidence would say. So it's a range of things. It isn't that the economy lacks stimulus. Usually in every other expansion, it's that there aren't enough jobs and people can't find jobs, and we're stimulating demand and trying to get demand to come up. That's not the problem here. The problem is a supply side problem, which what it would take to work it out, I think it's going to be time. And number one thing it would really be to have the pandemic get under control. That's what everyone would really like to see. What does the labor market look like in a world without COVID? That would be the thing that we'd really like to see. But it doesn't look like that's coming anytime soon.
And just to quickly follow up on that, if some of the reason that labor force participation isn't back to, February 2020 levels because people are voluntarily making life decisions that are different, does that make you think we're going to end up at a lower rate overall?
Well, there's a demographic trend underlying all of this. And we actually got above the demographic trend at the end of the last expansion. So one would expect over time that labor force participation would move down because in an aging population, the older people are, the lower their participation rate is. So you would expect that the trend would be lower and that over time participation would move down. The question of how much we can get back up closer to where we were in February of 2020, and indeed for the year or so before that, is a good one. And but what we can do is try to create the conditions. There's a lot of good for society when you have a tight but stable labor market where people are coming in, they're getting in the labor force, they're getting paid well. In the labor market we had before, we had the biggest wage increases were going to people at the bottom end of the wage spectrum for the last couple of years. There were just a lot of really desirable aspects of a labor market like that. Higher participation is one of them, and we'd love to get back there. But again, ultimately, we have the tools that we have, which are essentially to stimulate demand and also to control inflation. Really, it might be one of the two big threats to getting back to maximum employment is actually high inflation. Because to get back to where we were, the evidence grows that it's going to take some time. And what we need is another long expansion like the ones we've been having over the last 40 years. We've had, I think, 3 of the 4 longest in our recorded history, including the last one, which was the longest in our recorded history. That's what it would really take to get back to the kind of labor market we'd like to see. And to have that happen, we need to make sure that we maintain price stability.
Okay, let's go to Edward Lawrence at Fox.
Thanks, Michelle, and thanks for taking the question, Chair Powell. So I was looking at the census data there for estimated monthly changes on sales, and what you're seeing is fewer people spending at restaurants and drinking places, more people spending at grocery stores. You see electronic sales down 4.6% month over month. Also, department store sales down 5.4% month over month. how concerned, or what is your level of concern the consumer may be turning away from this economy or pulling back because of inflation, the virus, or something else? Thank you.
We see consumer expenses very strong in this quarter. I don't know, Edward, whether you're talking about more shopping online versus shopping in the store, but consumer demand is very strong. Incomes are very strong, because people are going back to work and they're getting wage increases. Admittedly, some of the wage increases is being eaten away by inflation, but nonetheless, incomes overall are going up really significantly because of increased employment, and spending has been strong. There may be something in the seasonality that this year's holiday spending may have been pulled forward, and of course there may be effects from Delta, and there might be going forward from Omicron. But fundamentally, the consumer is really healthy, and we expect personal consumption expenditures to be pretty strong in the fourth quarter.
Okay, let's go to Mike at Bloomberg.
Mr. Chairman, the median forecast for inflation in this month's or this meeting's economic projections has been revised up significantly for 2021, but barely moved for 2022 and 2023. You've said you expect inflation to fall significantly. Is that because you're going to raise interest rates, or because the virus is going to fade and the effects are going to fade? In other words, is it a question of when, not if, you raise interest rates? And does it suggest that maybe your critics are correct and you might be afraid you're behind the curve?
So actually, I'm looking at the SEP here, and the median forecasts for core and headline inflation did move up by 0.4 each. So that's a significant, in an SEP, that's a pretty significant move up. It's based on both of those things, I suppose. I do think there's a broad expectation among forecasters, including our own, that the bottlenecks will alleviate sometime over the course of this year. If you look at where blue chip forecasts are, which is the group of well-resourced large forecasting operations with a long track record, they'll show inflation coming back down significantly toward the back end of next year. I would say, though, as well, that our policy should begin to have an effect. There will be a lag, but it should begin to have an effect on that as well. That's the most likely case. I guess what the thing I would want to say, though, is we can't act as though that's a certainty, and we're not going to act as though that's a certainty. There's a real risk now, I believe, that inflation may be more persistent, and that may be putting inflation expectations under pressure, and that the risk of higher inflation becoming entrenched has increased. It's certainly increased. I don't think it's high at this moment, but I think it's increased. And I think that's part of the reason behind our move today, is to put ourselves in a position to be able to deal with that risk. And I think we are in a position to deal with that risk. We need to see more data. We need to see how the inflation data and all the data evolve in coming months. But we are prepared to use our tools to make sure that higher inflation doesn't get entrenched. For one reason, as I just mentioned, it's one of the two big threats, the other being the pandemic itself, to getting back to maximum employment.
Let's go to Michael Derby, The Wall Street Journal.
Yeah, thank you for taking my question. So as the Fed shifts towards an accelerated taper, I wonder what your read is on financial stability risks right now. I mean, these periods can be, seems like the taper process has gone fairly smooth so far, but, what do you see in terms of stability risks? Are there any parts of the financial sector that concern you right now? And are there any significant systemic issues that are on your radar, maybe from the cryptocurrency sector or something like that?
We have had now for a decade and more a 4-part financial stability framework that we use, so we can hold ourselves to the same kind of framework and not just treat each event individually. And there are 4 key areas: asset valuations, debt owed by households and businesses, funding risk, and leverage among financial institutions. So I would say asset valuations, I'm going to go really superficially here, but asset valuations are somewhat elevated, I would say. Debt owed by businesses, and households. Households are in very strong financial shape. Businesses actually have a lot of debt, but their default rates are very, very low. But nonetheless, it's something we're watching. Funding risk is by and large low among financial institutions, but we do see money market funds as a vulnerability, and would applaud the SEC's action this week. Leverage among financial institutions is low in the sense that capital is high. So overall, financial stability. That's how I would make an overall characteristic, but we break it down into those pieces. In terms of the things that we're looking at, it's the things we've already talked about to some extent. It's the emergence of a new variant that could lead to significant economic. If there were to be a variant, for example, that were quite resistant to vaccines, it could have another significant effect on the economy. We don't see that. We don't have any basis for thinking that the new variant that we have is that one, but certainly one we're looking at. I would say, cyber risk, the risk of a successful cyber attack is, for me, always the most, one that we would be very difficult to deal with. I think we know how to deal with bad loans and things like that. I think more a cyber attack that were to take down a major financial institution or financial market utility would be a really significant financial stability risk that we haven't actually faced yet. So I could go on with a list of horribles, but I think that's a decent picture of where I would start.
How about the cryptocurrency issues? Anything that worries you there that's going on in there in terms of, it's obviously a lot's happening in that sector. Is that concern you at all?
I think the concerns there are not so much current financial stability concerns. I, of course, would support the views expressed in the President's Working Group report on stablecoins. Stablecoins can certainly be a useful, efficient, consumer-serving part of the financial system if they're properly regulated. And right now they aren't. And they have the potential to scale, particularly if they were to be associated with one of the very large tech networks that exist. And you could have a payment network that was immediately systemically important, close to immediately systemically important, that didn't have appropriate regulation and protections. The public relies on the government and the Fed in particular to make sure that the payment system is safe and reliable, as well as the dollar, and to provide a safe and reliable, trusted currency. So, but I do think those are longer term. In terms of the more the cryptocurrencies that are really speculative assets, I don't see them as a financial stability concern at the moment. I do think they are risky. They're not backed by anything, and I think there's big consumer issues for consumers who may or may not understand what they're getting, and there's certainly developments in the markets that are worth following, which are really not in our jurisdiction, but things like the kind of leverage that's built into them and those sorts of things is certainly worth watching.
Let's go to Nancy Marshall-Genzer at Marketplace.
Chair Powell. Hi, Chair Powell. Thanks for the question. Going back to inflation, is the Fed behind the curtain on getting inflation under control?
So I would say this. I actually think we are well positioned to deal with what's coming, with the range of plausible outcomes that can come. I do, and I think if you look at how we got here, I do think we've been adapting to the incoming data really all the way along, and noticing and calling out that both the effects and the persistence of inflation, of bottlenecks and labor shortages and things like that. So we've been calling out the fact that were becoming longer and more persistent and larger. And now we're in a position where we're ending our taper within the next, by March, in 2 meetings, and we'll be in a position to raise interest rates as and when we think it's appropriate, and we will, to the extent that's appropriate. At the same time, we're going to be seeing a few more months of data I don't actually think we're out of position now. I think this was an important move for us to make. I think that the data that we got toward the end of the fall was a really strong signal that inflation is more persistent and higher, and that the risk of it remaining higher for longer has grown. And I think we're reacting to that now. We'll continue to adapt our policy. So I wouldn't look at it that we're behind the curve. I would look at it that we're actually in position now to take the steps that we'll need to take, in a thoughtful manner to address all of the issues, including that of too high inflation.
Let's go to Evan at Market News.
Hi, Chair Powell. Thank you. I was wondering if we should still be seeing the taper and interest rate hikes as separate. And secondly, in the last cycle, the Fed started shrinking the balance sheet when short-term interest rates were about 1 to 1.25% range. Do you think the FOMC might be able to potentially start running off assets before that this time?
Are they separate? So our interest rate, they are separate tools. So that, the asset purchases are a separate tool from interest rates. Stopping asset purchases does not remove accommodation. It just stops adding further accommodation, whereas raising interest rates starts to remove accommodation from what is a highly accommodative stance. The extent to which they'll be separated in time is something we haven't really discussed at the committee yet. We will be discussing that obviously in coming meetings. I don't think that the last cycle there was quite a long separation before interest rates. I don't think that's at all likely in this cycle. We're in a very, very different place with high inflation, strong growth, a really strong economy. That as I mentioned, the SEP medians are for 4% growth next year, 3.5% unemployment at the end of the year, and the headline inflation of 2.6% next year, core at 2.7. So this is a strong economy, one in which it's appropriate for interest rate hikes. So they're separate, I would say. Your second question was?
My second question was about runoff.
Runoff
in the last cycle.
So with the balance sheet, we did have a balance sheet discussion. It's our sort of a first discussion of balance sheet issues at our meeting this week. We'll have another at the next meeting and another at the meeting after that. I suspect these are interesting issues to discuss. Didn't make any decisions today. We looked back at what happened in the last cycle, and people thought that was interesting and informative. But to one degree or another, people noted that this is just a different situation, and those differences should inform the decisions we make about the balance sheet this time. So haven't made any decisions at all about when runoff would start. But we'll be continuing to, in relation to when either liftoff happens or the end of the taper. But those are exactly the decisions we'll be turning to in coming meetings.
Thank you. We'll go to Scott Horsley at NPR.
Thanks, Mr. Chairman. I think you said a few minutes ago that the inflation that we got during the pandemic was not the inflation that you anticipated when you crafted the framework, and you described it as a collision of a lot of monetary and fiscal stimulus with these supply side hiccups. Does that mean the stimulus was mistaken, or is the inflation just a consequence that we have to put up with because of that?
No, I'm not expressing any judgment about the stimulus in that comment. What I'm saying is there's a sense among some that you wanted inflation. This is what you wanted. How do you like it? And the truth is, this is not the inflation what we were talking about in the framework was inflation that comes from a tight labor market, right? So we had 3.5% unemployment for a period, and we had inflation that was just barely getting to 2%. And, I think in that setting, our thinking was we can afford to wait to raise rates until we see actual inflation rather than preemptive, because, no one had seen what 3.5% unemployment would look like with high labor force participation, by the way. No one had seen what it would really look like for an extended period for decades. And we didn't know what the inflationary implications were. It turned out there was barely 2% inflation and no sense that it was gaining momentum and that kind of thing. So we incorporated that into our framework. This is something completely different. You know, that's a situation where you had a very, very high level of employment and low inflation. This is literally the opposite, or, you know, it has been the opposite, where we have very high inflation, and we've had it since the labor market was in terrible shape. It had nothing. So far, this inflation has really nothing to do with tightness in the labor market. It does have to do with strong demand, and strong demand was supported by the Fed. It was supported by Congress. I'm not making any judgments on Congress. It's not my job, but I will just say we're coming out of what we certainly hope will be a once in a lifetime, certainly historic, the first really global modern pandemic, which looked at the beginning like it might cause a global depression. And, you know, so we threw a lot of support at it. And what's coming out now is, you know, really strong growth, really strong demand, high incomes and all that kind of thing. You know, people will judge in 25 years whether we overdid it or not. But, you know, the reality is we are where we are. And, you know, we think our policy is the right one for the situation that we're in.
Thank you. Let's go to Brian Chung.
Hi, Chairman Powell. Wanted to ask about the bond markets. When you see the 10-year at 146 basis points, do you have any sort of concerns about an environment by which you might be hiking interest rates into? Would you prefer the curve be a little bit steeper? What are you gleaning from the bond market actions over the last 6 weeks?
So I think the short end actions are easy to understand, which is, you know, they're basically very policy sensitive rates at the short end, and it makes sense that it's reacting to changes in expectations for policy. I think a lot of things go into the long rates, and the place I would start is just look at global sovereign yields around the world. Look at JGBs, look at bunds, and they're so much lower. You can get, you know, a much higher yield on U.S. Treasuries by buying USTs rather than bunds, and you can hedge the currency risk back into yen, back into euros, and still be way ahead. So in a way, it's not surprising that there's a lot of demand for U.S. sovereigns in a world, you know, in a risk-free world where they're yielding so much more than bunds or than JGBs. So that's a big part of it. I also think, you know, there may be some assessment in there of what the neutral rate is or what the terminal rate is. I don't know about that, but I would just say that we write down our own estimates of the terminal rate or the neutral rate of interest. Those are highly uncertain, and, you know, we'll make policy based on what we're seeing in the economy rather than based on what a model might say the neutral rate is. We all had the experience of the last cycle, where we all through that cycle were trying to estimate what the neutral rate was, and it turned out, you know, I think we learned a lot from seeing what happens. We ended up cutting rates 3 times after raising them to 2.25% to 2.5%. So I'm not troubled by where the long bond is. I see that it's low. I mean, we're really focused on broader financial conditions. We're focused on maximum employment and price stability.
Thank you. For the last question, we'll go to Greg Robb.
Thank you very much. Chair Powell, I was wanted to give you the opportunity to talk about something I've heard that's been discussed, that, you know, your pivot towards a tighter policy, hawkish policy stance had something to do with the timing of your re-nomination by the president. Thank you.
Sure, I'd be happy to talk about that. So as I mentioned, we got the ECI reading just before the November meeting. We got the labor market report 2 days after the meeting, and then 1 week after that, I think on the 12th of November, we got the CPI reading. It was really the CPI reading in concert with those two. And I just came to the view over that weekend that we needed to speed up the taper, and we started working on that. That's a full 10 days or so before the president made a decision on renominating me. So honestly, it had nothing to do with that at all. And I just thought, this is what we got to do. My colleagues were out talking about a faster taper, and that doesn't happen by accident. They were out talking about a fetch table before the president made his decision. So it's a decision that effectively was in more than in train, and to the point where people were talking about it publicly. So that's what happened, and it had absolutely nothing to do with it whatsoever. We're always going to just do what we think is the right thing, and I certainly will always just do what I think the right thing is for the economy and for the people that we serve.
Just a quick follow-up. I guess that some people are saying that it was the stimulus in March that was sort of over. We didn't really need all that stimulus, and that there was talk even then that would be a mistake and it would lead to higher inflation, and perhaps that you didn't push back as much as you might have otherwise.
I didn't push back at all, and the reason I didn't, and there was lots of talk about that, but not from the Fed, because that is not our job. We are not the CBO, and we're not elected by anybody. So we take fiscal policy as it arrives at our front door, and we don't comment. We make our own assessments inside the Fed, but it's really not our role. And I think very important that we stay out of that business, no matter who's in the White House, who's in Congress. It's just not our job, and it's something we avoid pretty assiduously. Thank you.
Thank you, Mr. Chair. Thank you, everyone.
Chair Powell wrapping up his press conference just there. Welcome to the closing bell, everyone. I'm Wilfred Frost, along with Kayla Tashi, who is in for Sarah Eisen today and joining us from DC. Stocks at session highs, rallying sharply, both on the original release of the statement, but during that press conference too. The Nasdaq's now 1.7%. There's the Dow up a 4%, 353 points. The low of the session was down 154, so a big swing during the session. Tom Lee just saying it's a buy the rumor, sell the rumor, buy the fact type moment. It was hawkish. It was a change of direction, doubling the pace of the taper. 10 members saying 3 hikes next year, 5 others saying 2 hikes next year, but perhaps not more hawkish than expected, Kayla, and that has allowed stocks to rally significantly.
Yeah, and despite how much of that has been telegraphed beforehand, the market likes what it is seeing and hearing from Fed Chair Powell just now. Our panel of experts are standing by to break down those comments from Jay Powell, with the Federal Reserve wiping transitory from the statement, doubling down on taper and committing to possibly 3 rate hikes next year. And coming up later on in Closing Bell, the CEO of Eli Lilly.
All right, that's pretty much the fireworks for today.
That stock leading the S&P 500 today, adding to the big gains on the year.
See if they got
Plus,
anything
the
else.
CEO
I don't think they have
of
anything
eBay
else to
will
say.
be with us to discuss today's somewhat soft retail sales number and whether that matches what he's seeing from customers. All that ahead.
Right, soft retail sales. If you guys didn't know, retail numbers came out today. Retail sales number, that is. So that was another data point that came out today, also reflecting the value of why, even with a holiday season like this, there's less people, frequenting the department stores, right? So yeah, that says a lot about the importance of inflation, right?
I think it's there were fears out there, Wolf, that he was.
All right, so now they're finna bring on the analysts so they can sit there and ponder why they were. We don't need to hear all that because we know what that's going to be about. Again, they cater to clients who are, investing in, basically who trust them fiduciary, from a perspective of, being a part of their fund. So they got to always speak a good game to let everybody know that, everything is fine and stay in the market, and I'll get it. So we'll have our own commentary because, again, we're going to speak from a real world perspective. Right? Even though we Wall Street, inclined, we're Main Street minded, meaning we think about the people first, right? Regardless of our individual purses and things that we do. But when we look at the broad economy as a whole, we realize that there's a lot of problems, right? There's a lot of air pockets and cracks and crevices underneath this economy that's being glued together by super glue, paste, Elmer's paste, glue, sticky paper, you name it. They got staples, everything. They prop this thing up and make it look good. Why? Because there's this bravado value that has to come along with being in America, that, there's no mountain too high to climb, no valley too low. We can't. It's that perspective, right? Again, make it sound good, even though it doesn't necessarily, look good. So with that being said, of course, as market participants, we realize the power of opportunity, right? With any opportunity that we invest in, look at this thing finna go to 470. Man, I closed them calls out maybe about another a dollar too short, a dollar. Well, close to about $1 short, but that's fine because you never cry about money made, right? A bear, the bird in hand beat one in the bush. But I do got again a swing call into Friday, December 17th, 470 expiration. So that one just up. That been printing really hard. And I literally bought that one down in the 464s. I mean, up substantially. I'm so tempted to close it out. But again, I got, 2 days of expiration on it. I think that the futures market, even though the language tonight is very bad, being honest, the language is very bad. Meaning, when I say the language is bad, meaning we kind of got an idea that these were the things that were going to happen. The only thing we didn't factor in was that extra rate hike, right? That potential of 3 rate hikes by 2022, right? Because we were saying 1 by summer, right? But the potential maybe 2 by the end of the year. That's potential, right? Because we're thinking like, okay, these people are so greedy, they'll never, put that language out there, despite PPI being up near their dang near 10%, CPI being up basically 7%. Well, we know it's more than that because they don't include food and energy in the CPI numbers. Like how do you those are 2 things that Americans consume more than anything, right? Power and food. Now, how do you don't include those in your consumer price index? Well, of course, that's window dressing. That's to make the number not as worse as it is, to say that the other things are more transitory because they're more discretional as opposed to staples, right? So if you guys ever had to think about why they never include energy and food, because they consider food and energy staple values, right? They're pretty much sedentary, they're ubiquitous. And so you can kind of draw a line within that to kind of say this is why things will be peaked or whatever based upon the economy, meaning people being able to work at some point, produce at some point, and then from there, you will have that grocery store kind of meet, the level of the wage value of the money being spent. The same with energy, right? Because you can't power your house with what? Candles alone, right? This ain't the 18th century, right? Or the 17th century. However, this is the cooking of the books literally right in front of your face. Like, if you're going to put data out, put all of it out. Be transparent from top to bottom. Let people know the severity of the situation, because again, people not banking the ideal of the inflation on a lot of the stuff that Wall Street wants to kind of, I don't know, fantasize about, this is why things are not as bad and as transitory, even though we know that word is pretty much need to be excommunicated from the Webster Dictionary going forward, right? Because they can never use that word ever again in history. To the tune where, again, we have a run on the balance sheet of the Federal Reserve up to about $9 trillion. Majority of that came basically under COVID, right? And we're talking about a debt that's going to be paid forward to future generation, right? I think national debt is not like 30 trillion. I think we're around about 30 trillion on national debt. Matter of fact, let me pull up the clock real quick while we're talking about it, right? We're right up near it, right? So I want people to see. I mean, last time we did a segment on the national debt. I don't know if you guys remember that, a live stream we did. I think we were at that point, we're sitting at around about maybe 25-ish, 26-ish, somewhere around there, maybe, give or take, might be a little lower. Well, guess where we're at now? Dun, 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 drum roll, right? Yeah, keep running, Spy. Keep running. Just keep making money on this last little call. I know I should have said, I should have rolled 2 instead of 1. But again, can't complain. Bird in the hand beat one in the bush. I closed out like three that I had. That was for the 466 calls for the intraday today. Why? What did I choose 466? Well, because we know that's a resistance point that the markets had to close above, right? Or in order for it to stay somewhat bullish. If not, the bears were going to push it down lower, right? So no worries. But moving on. So let's get to this real quick. So I want to show y'all exactly where we at in terms of national debt. Like some people care, some people don't care. People like, man, people ain't gonna never pay it off anyway, so why even bother? I agree with all those statements. But I will say this. This is just pretty much an extension of why, if you are a person who are who are emotionally compromised about politics, about health and science, about, again, there's dogma on all aspects, right? There's no conclusive evidence about nothing in life because life is about variables, right? There's wavering factors, right? So it's hard to speak in absolutes. But I will say this, on a concrete perspective of understanding how policy, doesn't necessarily, reflect that of the citizen value in terms of America. I'm speaking strictly on America here. Then you guys got to understand that the corporation that we somewhat, play down sometimes, but some people guarded it up a little bit more than what it is. But we don't realize that this basically is pretty much a incorporation where the state's underneath the major umbrella, and everybody got to fight to kind of stay within the mandates of the corporation as a whole, right? Meaning Washington, D.C., which is obviously not a state, right? You guys get that as a province. Again, I'm talking to smart people, I get that. But I'm just trying to lay a framework for you to understand that the idea that the generations, going back as far as the roaring 20s, right? They used to talk about a lot about the roaring 20s and how the American economy was booming. Then, of course, we had a crash, right? Then they went into war, right? They went to fighting their own war. They went to fighting everybody else's war, and that really drug the economy even more, right? We saw the extent of how, they utilized the ideal of birthing such an industry like the Fed, or a private organization like the Fed, to come in and kind of be the back end henchman for coming up with this idea that we're gonna, subsidize our debt. We're gonna make sure that we never falter, because we do realize that our revolution, industrial revolution, is still yet to take off, even with the fact that it was fighting the war, right? World War I, World War II, right? Again, it costs a lot of money to fight a war, right? And the people that's in the military, y'all know what I'm talking about, right? Or been there. But anyway, those debts were also always paid forward, right? In terms of that, because that's how you accrue your most debt, is when you go to war, essentially, period. Outside of that, yeah, we witnessed a pandemic in our lifetime. So, like Jerome did say, within our modern, in the modern world, this is the first pandemic of such a magnitude where we had to live, or we're living through it. And the idea that, like he said, they want it to be better, what they call safe than sorry, right? So overshoot your goal. That way you don't undermine the severity of what it could be. Well, in doing so, therein lies the problem. Why? Because again, if you were already at a place where you were never, really quite back to being in what we consider to be a surplus economy, where there's, enough where we can really spread it around, where it can really benefit those who really pay into this system, what we call America, the taxes and all that. There's a inequality there, of course it is, right? Wealthy obviously then have the people who have not. Then it only gets exacerbated more when you convince yourself that, well, we're going to add all this money essentially to backstop all of our debt-laden assets in a way where at least that gives us some perspective of solace, that if we can't necessarily feed our family, we can't drive our cars because we can't pay for gas, and we can't do some of the basic things that we figure to be, normal in America, or accoutrements of just living here, then you should be happy with that. At least you still got a, soil underneath your feet that's, paid for, right? Or a roof over your head that's covered, right? Through a moratorium, right? Or student loan that's on forbearance because of the COVID. You don't have to pay that off right now. Then you should be happy, at least, right? Yeah, in between time, eat a little air sandwich here, do your little syrup sandwich, or get your little pack of rummas and just chill out. That's the message literally that they sent to Main Street. While we saw record number of profits of bad fiduciary responsible companies benefiting off tax dollars in terms of them being bailed out for, again, exorbitant, excuse me, I should say exuberant financial bonuses going to the CEOs and the board of directors. Y'all know the game plan. This is America. You would think at some point Main Street will wake up and realize that they've been hoodwinked, they've been bamboozled again, and start to really do something about it. That's why I think the difference between the Republican and the Democrat today is essentially where they just pretty much morphed and became, like the whole Voltron thing, where nobody really is going to really take these people serious going forward. And they're going to make it harder for future people coming into policy or into office to really stand out from maybe, the game plan that has morphed into this radical politician of today, where they're upfront, in your face, outright, I'm Proud Boys, I'm Oath Keeper, I'm Black Lives Matter, I'm whatever. And that's that. My common ground does not necessarily equate to, really having a partisan perspective, right? Where it matters in terms of everybody being inclusive, right? Right. The whole ideal that people can come together and formulate ideas with money, innovation, to make it a better mousetrap for everybody to benefit from. Well, I think those days are pretty much long gone. And I'm saying that only because, again, when you look at $9 trillion in the last year, literally 2 years, but we'll say about near 2 years, right? Near 2 years. That's more than literally 3 to 4 sitting presidents on a 4-year term where you would have such a run on in terms of the Fed balance sheets. They did all that in under 2 years. $9 trillion. Again, the idea of the overshooting, overstating the situation to the tune now where we're having record inflation. We're literally dealing with stagflation. They don't want to say it like anything. They'll never say these things outright. The same way it took them a long time, like pulling teeth to retire the word transitory. When we was telling them, like literally everybody knew that the word transitory was the worst thing ever to say, and they just kept saying it, because they understand how this stuff works in Wall Street. Is that once that printer or that enter button is pressed and that money is sent down range, you can't resend it back. They can overpay you in income tax and the IRS will come back and get it. They can overpay you in student loan value and a tuition or whatever, or a Pell Grant disbursement, whatever. And if it's more than what they plan to, they can come take it back. Your employer can overpay you by extra $200-300 or whatever on your check or whatever. And guess what? At the end of the day, they can come take it back. When money goes into the stock market through policy, through reverse repo operations and the bonds that are coming, going into the Fed, and the Feds exchange that for cash for banks, the banks to go out and buy assets and so-called lend money, which they're not more or less lending. They're just buying assets and benefiting off the profits in that, and acting like they're doing the will of the people by saying, hey, your banking system is there to protect you because we know that you need to file for EIDL loans, and we're going to help you with that. We're going to give you loans to get you started. Again, they're playing on you to always remain in a debt-based society so they can feed off your fear that you need them more than you need yourself. Why? And when they take, literally all the profit value that they're going to, again, make out of this chaotic situation, and then take that fiat value and then go out there and buy real tangible assets with it. The land that you're particularly going to be kicked out up off of at some point if you can't pay your bills because of inflation and the unemployment situation, and wage gains are not as extenuous as that of the ideal of what inflation kicking people in the teeth. Again, the cost of grief perspective now is not even, it's a laughing joke. It's to the degree where at one point associate used to really put you in the door. A bachelor's guaranteed you some kind of form of stability. A master put you in a higher perspective of being able to move up the ranks faster. A PhD pretty much guarantees you tenure basically on a job. You are asset, to the company. Now you can pretty much, one up that in terms of the value of what you not have to shoot for now to even be considered in the labor force to be protected. Meaning a bachelor's won't even suffice anymore. You have to get a master's or above. Why? Because not only that, the price valuations on things are going to continuously go up. Inflation is just another way to say these things are going to become static. They're going to become analog, meaning they're going to be here to stay. There's no dynamic rolling where we're just going to just decompress and go back to basically where it was before. That's not how this stuff works, guys. If they're telling y'all different, they're lying to you. This is a test to see how much pain or threshold that you can muster and maintain. And once they know that people can find a way, they'll continuously doing what they've been doing. Right? Again, this is, for me, the politics aside, because again, That's how they keep you divided, and that's to think that your side is the problem as opposed to the other side. No, it's a joint task force of both saying, how can we milk this? Why? Because they're more concerned with milk, eggs, and cheese and bacon. We're concerned with Apple, Netflix, Amazon, Google, land, right? Appreciation or depreciation, asset ownership. Why? Because once we get that ball rolling, it can't be rescinded back. You see how that work? They don't rescind money out of the stock market. Okay, we can stop adding money to it in terms of QE, quantitative easing, liquidity flushes, but there's never a moment in stock market history where they went in and pulled all the money out from perspective of saying we've added all this, so now this aspect of stimulating the economy, and that's how y'all know it, right? Because that money goes into the pockets of the CEOs, right? The company. They take that money, either innovate with it, grow their scenario, or they do a lot of buybacks with the money. That's what they've been doing. They take that infusion of cash that's been coming on the back end of the shareholders and the stimulation that came from the Federal Reserve, and it's not that they've been able to create a better mousetrap for you and I to be able to live underneath, right? They took that money and did what? Sat on it and did buybacks. They bought shares with it to increase their enrich the price of their stocks. Apple is no more of an innovative company than it was way back in the early 2000s and end of 90s. Show me something that Apple has really innovated that's been groundbreaking enough to give them such a valuation. They have no organic growth. But yet this company's about worth $3 trillion. More than nations, like more than hundreds of nations out there on the planet alone. Apple got more money on their market cap than they have in the entire economies of countries around the planet. See, this is the hustle of why people convince themselves why they can, parlay the ideal of wanting to learn how to invest into, no, I think I'll go work harder and I'll make it that way, because investing in the stock market is either gambling or it's something that, I'm just, I feel like I'm just not, capable of being able to learn. You heard stuff like it's a scam, like seriously, it's like these are talking points. Yet they're being priced out of the market through the labor participation, because the fact that the wage is not going to be able to equate to that of what the national debt and inflationary value that we're dealing with now is hitting them across the head. So they overcompensate by trying to upgrade their education. That's going to really help. Like, you getting more programming ain't going to really help the bottom line if you don't have the value of being able to watch money appreciate much faster than you can work for it, outside of your care and concern of working for it. Unless you hit the lottery, you subjected to that national debt, right? Ballooning more on the value that these people going to always, again, err on the side of what? The stock market first. The saying is that the economy is supposed to be a representation of the Main Street rally of the world, right? Or the economy, right? Of that nation. Well, we know that's a lie, even though that's how it's supposed to be, but we know that they've kind of switched that up a long time ago and they put it on the back of Wall Street. Wall Street is the barometer that all nations look towards in terms of the extent of the economy. Why? Because they invest majority of their dollars into the USD dollar or our stocks for that reason. They want to be in our markets for that reason. Why? Because we have the ultimate king boss central banker than that of even the Japan's minister over there, right? We know that guy Kuroda, he was like a beast at print money. That's why the economy is pretty much just never coming back, seems like, in Japan, but that's another conversation. But this is the hustle. So this is why we take this information very serious. This is why we want to be more prudent and learning how to be thorough and using asset ownership as a tool of generating money and wealth. And no matter where you are in your journey within this, at least you're in the game. Because again, we just witnessed a market that produced well over 20 some odd, where basically up near 30% as of today's pump. And year over year gains thus far, the year ain't even over yet. And the SP 500 alone is up over 30+% this year. Last year, it went up over dang near 140% during the pandemic. During a pandemic, the market went up over 140% in 1 year. Dang near. Now, convince me how you're going to beat that, pulling up your bootstrap and going to work hard for somebody like you, John Henry or somebody, or Paul Bunyan or somebody. Make that make sense. You're trying to play ball in a system that's obviously, for what it's worth, rigged against you. These numbers here mean nothing to a person that's getting ready to go to the grave in the next 10, 20, 15 years. Why? Because they can rob all they can now, right? Pay that, that aspect of wealth creation forward, to their heirs, their future generation, and they can be fine. It's a free for all. It's get all you can, leave no stone unturned, pump everything you can pump. Always say that it's good when it's ain't, and err on the side that you're going to be protected first above all people, like a bun hosman, and the value of a bad business practice where the bun person get bailed out first, and whatever's left go to the shareholder or the common man or the layman. This is how this game works in America. We've moved off the standard of real wealth creation by the value of bartering and organic growth and real money valuations. It's more of a circus, if you will, of let's print and do much as we can, because at some point when it all implodes, then therefore in their mind, that's when the nation goes. The ideal of America goes in that point. I don't see that happening no time soon. And majority of everybody that's here listening tonight, it's going to outlive you. So you might not even try to play that game of trying to time it now, right? Don't waste your time doing that. You best prepare how to be sharp at this now and prepare your future generation to be able to deal with this. Prepare your children to deal with this, to learn this at early ages. At early ages, you need to be sitting down with them, teaching them this stuff, literally line for line, verbiage for vernacular, all that. They need to learn this stuff like yesterday. You cannot escape the reality of understanding just how brutal this market really is. Meaning the ideal of it in terms of they're not going to take an L. One way or the other, they're going to take an L. What you're seeing today in the stock market going up because of this news, this is what they consider to be, okay, it could have been worse, even though it's worse, but it's always a next level of an excuse when it comes to saying we need accommodation. If there's any inkling of the idea that there's some big bad boogeyman out there, we cannot stomach the ideal of, missing, a porterhouse steak dinner tonight, because we have to be more frugal in our actions now, because we got to think about everybody as opposed to just us in Wall Street. Like, this is the energy. So you guys got to understand that for what it is. So you don't be out there, allowing yourself to be emotionally compromised and not understanding just how serious this game is, and why markets are always going to reward those who are who are participants in its growth aperture as a whole. This is the game. And so when we say it's a marathon, not a sprint, we mean that. When we say that you need to learn how to play ball, right, at levels, commensurate of that of, using the markets to benefit you in your situation, this is what we're talking about, right? We're not just sitting there just, making up stuff and throwing up stuff, or just trying to sound like we think we know what we're talking about. This is the name of the game. This is the strategy of wealth creation. So again, be understanding of this. Take your time, right? Realize that Apple or Tesla or whomever, these little companies, there are many more that's coming, right? There are many more that are coming, right? There's another Apple out there waiting to, evolve, that's probably already out there, but there's another Tesla waiting to evolve. There's always going to be another scenario in terms of a generational catalyst, right? And there goes the bell, right? There goes the bell, right? We ran the market until the close, and right now the market ended up well over, I would say easily, I would say close to about, where we at? I think we closed up near about 1% plus. 1.5%, nearly 2% run off the lows today on that Federal Reserve news with the Jerome Powell, coming back out there again after getting, hot coals right across his back, coming out speaking a very dovish tone to the best of his ability, understand that he hit them with some stuff that they weren't even prepared for, and 3 rate hikes as opposed to 1 to possibly 2, and the market still shrugged that off. Why? Because they feel like we got to have his back, right? We got to have his back. Why? Because he done this much for us over the past year and a half, near 2 years. We can't, turn our back on him now. This is Wall Street looking out for their man, is my point, right? This is Wall Street going to bat for their man, their guy, right? So again, you need not be confused when you see these numbers constantly ballooning, and you see the value that the national debt again is up where it's at, and you see that the value of again, right, the gross domestic product is in itself is struggling. It's struggling. Then you say to yourself, assets are priced at this premium, this multiple, and the real economy, the GDP, isn't reflecting that of what Main Street is feeling in terms of growth. Only companies are feeling the value in that. This is the reason why you should become more adamant and learning again how to now, play ball in a way where you too can benefit. Simple as that, right? Simple as that, right? Because again, there is no, there is no golden parachutes unless you have, stock ownership values, or land ownership, or business, ownership value where, you can move numbers around to work in your favor, right? And that's just the facts. That's just how this stuff works, guys. That's just how this stuff works. So student loan debt, they tried to sound good about that. Well, we know what's going on with that. That's the one bill that they could have wiped out in one swoop and put everybody in the game. Literally a reset. Right now, sitting at $1.7 trillion. The Federal Reserve balance sheet is now up $9 trillion. The majority of that money infused right into corporations and companies of America, that $9 trillion, and none of it really went to to eradicate student loan debt, which helps people obviously get back into the game thoroughly through being bailed out the way that they bailed out American Airlines, Delta, and Cheesecake Factory, and all these little, debt stuff. Credit card debt is at $1 trillion. About $6,000 in debt per holder of a credit card on average in America. $6,000. That number obviously ballooned a lot worse because of the pandemic. And they tell you that the consumer is flush with cash right now. The consumer got a lot of cash. They're just spending money. They're spending credit. They're spending on credit. There are a few people out there that can move with cash, but let's not get it twisted. A majority of the people are on credit right now. About $40,000 in student loan debt per person in America, per capita perspective. Those two alone, basically near $2.8 trillion there. If that could have got eradicated in one fell swoop of a bailout in terms of the government, this is your money anyway, it's taxpayers' money. That would have put a big reset in America's economy like you've ever seen before. Why? Because it would invigorate American people to come up out of the woodwork in the dark and say, you know what, now I get a chance to get, a new, opportunity or lease on life to really build something or chase my goals or open up a business all of a sudden and really do something to really, really infuse the economy with some real good growth. As opposed to all that money going to Apple, Netflix, Google, Tesla, Microsoft, NVIDIA, AMD, et cetera, et cetera, et cetera. Essentially what happened. So again, how are you going to win a game where you have no fight or representation that's really looking out for your best interest in a labor force, in a workforce, whatever that is, right? in a working environment. I got a master, I got a bachelor. Like, seriously, no disrespect to the people that brandish their little degrees like that any longer. Like, that stuff is like so old now. Like, no, people don't even like, look, seriously. It used to matter. It don't matter anymore. It don't even matter anymore. It has value, but it don't matter in terms of, a magnification of one's ability to look as it, as if he or she is a substantial, pillar of society. It does not work anymore. Again, you got people on TikTok, pulling down, 6-figure income just by, shaving a bird back. A little kid gluing a little doll house together. They're making 6 figures just doing that on YouTube with no education. So again, you're gonna have to realize how the scope of this stuff works, guys. And so, again, I'm not, trying to be the bearer of what they call the wake-up call reality news, but you have to see, again, this is how you're going to be able to, this is how you're going to succeed. This is how you're going to succeed, because you're going to have to play ball, right? Right. At the saying go, when in Rome, do as the Romans do, even though, I hate that terminology because I'm not a Roman and I don't come from that, right? My ancestors didn't have to, didn't come from that, right? But, the vernacular value that we use in this country is obviously, is reticent of that reality. Basically, you got to play, right? You got to pay to play to be in this country, right? Now, this is just one event of many. This is not a, this is just a tipping point for all things financial. It's not, but it's to show you, again, the extent of how these people really think, how they really feel about the average person who, to he or her, or her own, simple ignorance or not, how they can really care less whether you can survive this or you don't. Meaning the idea that, you're dealing with the pandemic. We know that's been politicized, whether you for or you against the vax. We know how that stuff goes. That's a whole nother conversation in itself, right? Because that's a whole lot of stuff that, whatever, right? Right. Don't waste your time trying to, rep one side over the other. You're going to lose in the battle of monetary value, because at the end of the day, you can have 1 million jabs and your bank account is ugly and you still going to die, right? For some kind of value of not being able to protect yourself, even financially, right? These are just, barriers of preventive maintenance. That's all they are, no more, no less. It doesn't make you any more or less equipped to deal with the real world because you got a jab, or you did not get a jab and you might be subjected to being, subjected to, catching this thing, and it may take you out. Now, even though the data still says that it's a 99% survival rate or 98% survival rate with or without the jab, but that's beyond the fact. I'm using that as a case study to say, yeah, along with, fortifying your position, you got to be in a position where you learn how to, again, move financially and physically, period, at the end of the day, above all things. As if, you don't have that much time left, right, to start working out a problem or a thesis to figure out how you're going to grow your wealth, right, or grow some kind of aspect of wealth. And no matter where you start from, again, at least you need to get started, right? Because, again, just showing you here on a rolling scale here, this is your market, right? I'm going to do 2019. Matter of fact, let's do it this way. Let's do 2017, right? Let's go back when Trump came into office, right? Let me show you this here, right? Let me show you how wild this is, right? Let me hold up. There we go. This is the so-called, the end of the world, right? This is the zombie moment, war of the worlds, plague, all that, all that, right? Pestilence, right? Flying locusts, all that. That was that was during that time, right? The ideal of the virus, essentially, right? This is the end result of unlimited quantitative easing ramped to the next level, right? 2.0 quantitative easing, overshooting that of even what Ben Bernanke did under the Obama era, under the subprime lending crash. This is that times 2, times 10 to be exact. This is literally a linear line. In market value, this would be considered a linear line straight up. And natural market, the market would have been about somewhere around about right here, 45-degree angle, around about $364. We're sitting at 470. That's an additional 110 points plus. Let that marinate for a moment. Now ask yourself, how much of that stuff really went to the Main Street America value to really help their situation? This is a play on chaos, the chaos theory. Bullets and the bandages, right? You produce both in that moment and you win twofold. Produce the bullets and the bandages. Let you kill each other and patch you up later. We benefit, we produce both of that, so we eat regardless. These people got 500 right on there. Look, you see that 500 right there? That ain't by accident, right? That pretty little 500 sitting up there right there, that ain't looking. They have targets for a reason. To them, it is a game. To real people who struggling, it's not a game. They'll whisk past a financial challenge. They hear somebody, the SP 500 made another record high today. And they'll cut it off so fast and go right to, let me go watch me some, Valley Girls Get Up or something like that. Or let me go watch Sports Center till I can't, keep my eyes open any longer. Bypass all stuff that has to deal with them, being in a position to really, really move their bottom line. And they go get inebriated in trivial things. Not that they can't enjoy it, but those become the things that take their attention way more than just learning how to be more proficient in life. Financially, that is. Because this right here, see, numbers don't lie. This is 218, right? We hit 218, we hit the low at 218 on March 23rd, and now we're sitting at 470. Somebody do the math on that. That's clearly over what? Clearly over 100%. You're talking about basically 250 points added to the market in under 2 years. You don't get those kind of gains ever. I repeat, ever, right? In markets, unless you can have an excuse to produce something of that magnitude to let people know this is why this is, incredible scenario. Look at this here. Going back to the subprime lending crash, 2007, 2008, right? You see this here? Look at the pullback we had then. Look at the gain that came after it. It took years to even get back to break even, right? Notice that? Everything looks good from the bottom up, but it took them years to get back to break even because of that. And that was because of what they call self-inflicted wounds on a greedy real estate, industry at that point that was taking advantage of vulnerable people with, adjustable rate mortgages, subprime mortgages, subprime mortgages, sub mortgages off a real mortgage. They were just hooking and booking and just robbing people. Now, to the tune of how many people lost homes and lost life and lost jobs. Look, the pandemic situation pales in comparison to that level of destruction because that removed people off their real estate. COVID just removed you away from your real estate because you maybe got sick or whatever, right? But you still had job, property, whatever. They made this worse than really that was. Well, it's the ideal of propaganda, the propagandist perspective of it to make you feel that way. But again, we're talking about something that has about a 0.99 to 0.98 survival rate. It's a 0.98 to 0.99 survival rate of you catching this that you can survive from it. But again, fear, doom and gloom always rules the roost at the end of the day. And so you have a market that says, oh, okay, let's go straight up. Let's pump all this money into it because that's the best way to backstop the economy is by putting the money in the markets, putting it in the hand of what they call smart people. We don't want to give it to the person that works at Denny's, that works at the Huddle House, that works down at the local, maybe the social worker that works down at the city hall, right? These people got degrees. All these people got, some of these people got degrees. The person that works down at, the local surveying company or y'all get it. So this is how this stuff works. This is how this stuff works. Again, that's 2008. $70 a share. Now it's sitting at 470. You're talking how many years there? How many years you talking about, buddy? Right? That's 15 years. 15 years to market and return then that of what? 800% return, dang near. Plus, somewhere around there. Dang near, somewhere around, yeah, near 800%. Show me how you're going to beat those gains in other aspects. And this is just SP 500, of course, but just showing you, right? You know, the extent of that. This is not going to end, right? Unless the entire corporation of America folds. That's the only way the stock market is going to go fold, essentially, right? That's essentially. Even going back to the dot-com bubble, right? The collapse we had then, see right here? Going into the dot-com bubble, right? Stuff like that, and you know, all that stuff, you know, they phased out in the Iraqi war, all that stuff, right? The whole idea with 9/11, on and on. Pull back, came back even, pull back, subprime, then rocket straight up. Look at that comparison there. Look at this. Look at that in comparison. Every time that they go through a chaotic moment, they figure out how to do it bigger and better the next time around. That's the part which you guys got to understand. This is an evolution. This is evolution on drugs. They figure out how to pump more money, be more liberal in the aspect of saying we're going to backstop this even more. We're going to bail out even more people. We're going to, now when I say bail out more people, that don't include you if you don't own assets. So don't get happy, right? They're going to bail out those who own assets first. And then they may think about flicking a crumb off the table to you. And they're going to make you feel bad about it. How dare you ask for something from your government? How dare you ask for, universal health care or something like that? It'll mess up the open market. See, they know how to play people against each other while they continue to funnel the money out the back door and put it right into the what? To the stock market. And people out there like, yeah, you tell them. You right, bro. You tell them. You tell them. Couldn't make this stuff up, guys. Could not make this stuff up. So until I have any last breath to offer you guys, I'm going to continually beat this drum to get our people excited about becoming asset owners, taking an equity stake ownership in some of these scenarios out there. Understand that the dollar cost average game is solid in terms of investing long-term and realizing the value of compounding interest is your friend. It's not your enemy or your foe. It's your friend, meaning when your money is working for you and you get a chance to discount shop the same way you feel like you're going to the grocery store or the dollar store or wherever, the Macy's, Nordstrom, Saks, Fifth Avenue, wherever, and you feel like, this is a sale time, a moment, where you can catch up on sale. You need to be thinking the same thing about owning the company outright as both their products themselves. And when it comes down a little cheaper and it pulls back 15, 20%, you don't panic. That's when you say, oh, don't panic. It's organic. This is what you want. Dollar cost average. I can buy more at a cheaper price. Why? Because this asset has proven to be what? A long standing of what? Growth and opportunity based upon its tenure in business as a business, as a whole. Publicly traded and or just private to public. See, that is that part. You have to be patient and let your money work and stop trying to pick at it every 2 seconds. Like you're going to have your hand in the midst every 2 seconds. You're never going to watch some stuff just not going to grow that way. Right? So, yeah, trust it. Trust the process. That's a very colloquial saying, right? In sports and also business and also definitely investing. Trust the process. Learn it first, of course. Knowledge brings power. Power equals profit. Learn it first and then trust the process. And guess what? And you have the ability to what? To pull your money at any point you feel like you want. There's no mandate to say you got to sit in it something that's bad. The same way you got to sit in a bad relationship, right? Yeah, you don't have to sit in that. You can move on. The world is big. It's an oyster, right? There's plenty of fish out there. But the same thing in the stock market. If one particular stock don't work out for a reason, right? You gave it enough time to really prove itself. There's tons of more. There's tens of thousands of companies that are publicly traded. Tens of thousands. And that's just American market. We're not even talking about the CSX, the Canadian markets, the TSX, excuse me, the Israeli market. You can invest in the African market. You can invest in these markets overseas. Hong Kong exchange. You have access to their market the same way they have access to ours. All you gotta do is go through your broker, pay that little tariff fee, and bam. But everybody knows the money is in American markets, obviously. Why? Because it's the land of decadence. So they want to be where the money's at. I implore you all to have that same mentality going forward. You want to be where the money's at. Now I can probably say this up front because we getting ready to do an end of the year review. And be looking back now, I'm kind of giving y'all the prequel of that, what that's gonna look like when we actually do that show one day before the end of the year. But this ain't nothing that we haven't been doing since I've been coming on anyway. We've been talking about the level of growth and opportunity, right? And people will say, well, the run is over. Now we're not gonna get those kind of gains that we got last year. Well, obviously not, right? We don't have 100% gain in the SP 500. Well, we got that last year, didn't we? But we still mustered out the way it's going, about 30+% going into the end of the year. That's 30% year over year. Show me how you beat those gains anywhere else. Unless you're a real estate broker and you took advantage of the housing, this whole idea of inflation, price of mortgages and stuff and going up, even the idea to move properties, whatever, it's a little, whatever. But aside of that, what else you got? Right? So yeah, even if the market only pump out number the measly 7-8% next year, if that, that's a win in Wall Street mind. Now, actually said that after what they just witnessed and being able to pump out this kind of money in the last year and a half, 2 years, you think they're gonna settle for 8% next year after being spoiled and got 100% 2020, 100+% in 2020, and then another 30+% in 2021? You think they're gonna be happy getting a 7-8% return on the SP 500 alone next year? Or you think they're gonna find a way to manufacture another scenario to keep the market pumping and still see if they can eke out another 15-20%? See, once the money gets to rolling, people feel like there ain't no other way to stop it. Again, you can't rescind money from the stock market. It just don't work that way. Right? So again, in closing, that's the message for today. You saw firsthand the extent of the need for greed. Remember, there's a video game actually called Need for Speed, right? This is the need for greed. That's a book I need to write, possibly, right? I mean, amongst many others. This is the need for greed. Again, Tina, there is no other alternative. You sat on your hands the entire year saying, I'm good on that. I don't need to put my little $5 in, my little $10 in. I'm good on that. And now them $5 or $10 are worth, $80, $70, $90, $100+, $200 plus, $300 plus. That's what they would be worth if you just invested, of course. But at some point, you're going to realize that, okay, yeah, I better learn because these people ain't got no breaks, right? They got no chill and they got no breaks. None. Right? None. So, we got a lot out of today. We realized that this is a play ball scenario. We're ready for it one way or the other, right? Risk on, risk off. Doesn't matter to us. We hedge. We're going to play, right? We're going to understand the rules of engagement and we're going to jump out there and do what we do, right? Right. As the saying goes, right? I don't always have a chopper, but when I do, I get to it, right? Right? And some of y'all understand affectionately what a chopper means if you from certain parts to certain parts, right? I don't always have a chopper, but when I do, I don't always have a chopper. When I do, I get to it when I need it, basically. Well, let your money be your chopper for you. That's what this is all about. Let your money be the chopper that you desire to have around you at all times for protection. Get to it. Right? Get to it and use it when necessary. Because you're going to have to realize that this is how this game works. If not, you're going to continuously find yourself, woe with me, I shoulda, coulda, woulda, downplaying the value of really protecting yourself for the future. Again, the 3 little pigs, right? You building your house with wet tissue. You build your future with wet tissue. Everybody's using sticks and stones and bricks and steel and metal. You're using wet tissue because you think you got time to play, right? You're going to find yourself like this right here, right? You're going to find yourself just like that right there. 5, 10 years later down the road, you're gonna be in straitjacket somewhere. Right? You playing crazy, trying to get a crazy check. I'm crazy. And when the Walmart just went crazy, I'm gonna get a crazy check. No, you should have been, getting your bag right. You should have been getting your bag right. Right? Diamond hand tissue. That's the overage. Right? Right? Get to the chopper. That's all I'm gonna say. Get to the chopper, right? Because you're gonna need it. Right? So that's why this stuff, again, is important, right? We don't want to find ourselves in a straitjacket nowhere. We want to make sure we're, again, prudent and we're persistent in our studying and our ability to want to learn and to grow from this, right? As simple as that, right? So in the meantime, while the market is rocketing and showing that, showing that it's not going to abate and they want to go higher, and guess what? Let's go higher. That's all I'm gonna say. Let's go higher. We're gonna keep pushing, right? We're gonna keep pushing, right? So that's the status, right? All I'm gonna say is push, right? Right. That's all I'm gonna say. Push, right? Because that's how Wall Street looks at things. They're gonna say, "Give me any excuse. Give me any excuse." Right? Give me any excuse to say it's not that bad, so we can what? Push, 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 push. That's all they care about. Pump, 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 pump. And you need to make sure your dollar's in the mix of that too, so it can pump right along with it. Again, we rent, release, we don't own. We rent and we lease, we do not own. That way we have no emotional connection to none of this stuff. We're trying to take all we can that we can muster and handle. Right? You never invest emotionally. You invest with strategy and understanding and knowledge and persistence and due diligence and discipline. Right? Don't be these guys on the sideline telling you ain't got to learn this. Now come over here and just let me tell you about, how it was in the Byzantine Empire and get no money from it. No, we don't want to be that. We don't want to be somebody just sitting around stuffing bananas in their face, talking about, intellectually masturbating, not putting none of that to a financial use. You need to start making sure you circle your wagons and get serious about understanding how this stuff is going to look forward going into next year. We literally in 2022 already. Right? It's time for you to tighten your circles down and get serious about, again, growing your future. Because if not, you're going to find yourself caught in those circles, doing nothing, going nowhere fast, spinning your wheels. And then you're going to be happy when Mr. Charlie pull up on the job. Mr. Charlie going to pull up on the job and be like, look right here. There's Mr. Charlie right here. He's going to pull up on you and be like, look, you're going to be able to tell your friend this is how Mr. Charlie roll up on you on one day. Right? He'll ride to work one day in a brand new Lamborghini. Right? And y'all gonna be like, man, this is nice. I said, wow, that's amazing car, Mr. Charlie. Mr. Charlie, like, yeah, it's nice. And look, kick the tires. Look at it. See, them things thick and they bad. I'm thinking with wide tires, ain't it? And he gonna say, hey, I want y'all all to know if y'all continue to work hard, put all your hours in, and strive for excellence, I'm gonna get another one next year. Matter of fact, I'm gonna upgrade it, right? And I'm gonna pull up on the job the same way I did this time around. I'm gonna show you the new model. So you can ooh and ah and wow and all that, while not helping your situation out one iota. Right? This is the game. This is the game. Right? So yeah, let's get serious. Right? Let's get serious. All right. So that's it. So again, I'm gonna end on that note. Again, it's been a great bill. Again, this was short notice, but again, it was the moment that we was all waiting for. We got the information that we needed. We know that this is much different than what they say it is, but we know that you're not going to stop greed. You either play ball or you sit on the sidelines. That's how this stuff works. You either play ball or you sit on the sidelines. That's it. Greed is good. And people who make money never complain about how they made it if they know they made it legally, to the extent that they know it's probably taken away from somebody else, even though it's happening, obviously, in some aspect of this, because we understand that $9 trillion is on the federal balance sheet because of this so-called pandemic. And the majority of that, again, did not really go to really subsidizing and helping Main Street the way that it's supposed to. These, again, your tax dollars that subsidize this. Your tax dollars are responsible for this stock market. Your tax dollars are responsible for this stock market. Hate, like, love it, or indifferent to it, those are just the facts. Right? Those are just the facts. Right? This is get all you can before you go to the grave. That's the mentality here. Right? So let's go. Right? So let's go. All right. So that's it, guys. So I'm gonna leave on that note. Again, I hope you guys enjoyed this special little broadcast, right? Of it's Fed's Day, right? Like Dre Day, right? It's Dre Day. This Fed's Day, right? This is Fed's Day, right? So that way you guys realize that, hey, the money is still flowing until they can they can muster any longer to say, it's time to kind of pull back. So the dinner is served, basically. I hope you guys were able to benefit from from those of you who were intraday trading the market for whatever value. You're supposed to be hedged in a way. You never go into a binary event like this and not be hedged. You never take a definite approach to markets getting able, to being truthful. You say, let me make sure I'm protected on both sides, because that's the energy you're going to get more than likely where you have such a binary event. And this one being a very important one. So I hope, you had calls, or you scalped some on the way once everything took off, right? Or you waited for all this stuff to kind of come out and then you took a position, because it was obvious, once, the information came out that, they tried to front run it best they could, price it in best they could, downplay it much as they could, so they can kind of, continuously feed off of the idea of let's get this Christmas rally going before we get up out of here, and we'll assess, next year. But for now, wife need a new Hermes bag, right? My son need a new pair of, Prada boots or whatever, something like that, or Gucci jacket or something. I don't know, right? That's the name of the game. So again, I repeat, in closing, I don't always have a chopper, but when I do, I get to it, right? Protection matters, right? Right? Protection matters. Get your money right. That's your chopper. Get your money right. That's your chopper. Get your money right. That is your chopper. Right? So you don't be confused. All right, guys. So that's it. So peace, power, and profit, everybody. Shimotep, thank y'all for coming through this evening. As always, like, share, and subscribe on the way out the door if you haven't already. If you want to cash out the brother, the cash out information is down below. We appreciate you and all that you do in supporting this channel. And stay tuned, because again, we'll be going live. Again, we have training tomorrow, of course, but anytime you see us go live, come hang out with us. Again, y'all know how we over here. We're open forum, right? We welcome everybody, right? We don't have any kind of political agenda, any kind of agenda. We're very unbiased, right? This is not an echo chamber. We don't do echo chambers. Echo chambers are bad for your health. Stay away from them, right? Learn how to be objective and learn how to have natural and open discussion and discourse and debate without making it personal. You learn in the process, learn how to be patient, right? And so we want to welcome everybody to come here, as long as you ain't crazy and wild and radical. But, we welcome everybody in this perspective, right? Just understand we try to keep it PG-13 much as possible, because we want to have young people follow up on these channels too, right? We're trying to teach them how to get excited about this stuff without them having to sift through all that kind of, extra verbose grown man and grown woman conversation. Make sense? All right, guys. Thank y'all for tuning in. Peace, power, and profit, everybody. See y'all back in the markets, right? As they say, trade safe, choose well, and stay green, my friends. Peace, everybody. Peace.